basically my mom gave me like $200,000 and I turned that into $1 million. So as a third-year university student, I had $1 million. And kind of looking back at the time, that was too much money for myself to handle. I really did not know what I was doing. And so it was kind of that unconscious incompetence and riding that market environment higher that kind of led me to my first pot of gold. This book left a very, very big impression because one of the main lessons that I kind of took away in trading, you kind of always want to conduct your business in the following order of importance, and it has to be one after the other. So the first is always preservation of capital, because if you run out of money, then you have no money to play with. And then so once you get that down, and you could focus on preserving your capital and keeping your losses small, that's where you can try and go for consistent profitability. And then the last thing is, once you've hit the first two and you've built up a cushion for yourself, that's when you have leeway to go for pursuit of superior returns. Look at this. So this was the highest volume ever in the entire history of this stock price, of this stock's life cycle. So that's kind of what you want to see. You want that volume on breakout. And then what happens after that is you get confirmation, another one, highest volume ever. So volume kind of confirms the price move. And very quickly, this just doubles, right? So like if you're risking about 7% for this trade, you size up accordingly, according to that trade risk. Very quickly, in about 4 sessions, you're hitting 10 times ATR from the 50-day. So the next day was Valentine's Day, and I distinctly remember this because it's Valentine's Day. So I brought my wife out for dinner and a movie, right? So we're going to have a romantic moment. And then after the movie, I checked my quotes because it was a pre-market, like 1 hour before market open. And I saw it served down 40%. I'm like, oh shit, what happened? And so I was scrolling news and I saw, NVIDIA disposed its entire stake in Serve. And I got whacked. So I got hit really hard. It was very, very bad. Before I knew it, whatever money I had left, I drew down 60 to 70%. When I finally gave up on shorting, I took a break. I distinctly remember sitting at the condo pool, kind of really out of it, and I couldn't bear to tell my wife that I was down. I drew the account down by 60 to 70%. It's okay. You'll eventually find your stride. It takes the whole 252 trading sessions in a year to string together a good return. So don't be in a rush. I think that mindset shift was what kind of helped me snowball 2025 into the return that it is. Kind of thinking, Oliver Kell likes to say this too, like slow is smooth, smooth is fast.
All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. This episode is brought to you by public.com. You can learn more about them later, as well as down below in the link in the description. Today, I'm really excited to have our guest joining us. He is Clement Ang, top performer in the 2025 U.S. Investing Championship with a return of over 150% in the $1 Million Money Manager division. And today we're going to go into the details of his process, his system, his favorite setups, and also the nuances of how much he risks per trade, how he enters positions, and ultimately how he sells. Clement also, just a few years ago, went through a significant drawdown. So I'm really looking forward to hearing about the lessons he learned, rebuilding his process and, building it into the system that is so successful today. So Clement, first of all, thank you so much for taking the time to be here with us today, and looking forward to, hearing about your story and your process as a whole. So thank you so much for being here.
Thank you, Richard. It's a pleasure to be here. We kind of briefly spoke earlier on. Like this kind of feels like a full circle moment for me because going through my whole trading journey, had you and the whole TraderLion YouTube channel, as well as the whole team behind it, in a sense that I've kind of watched a lot of these interviews and picking bits and pieces from all these traders that I was very inspired by and looked up to. And then kind of thinking that, what if one day I could also be interviewed by you? And it's finally happened. So it feels kind of surreal. Really humbled and grateful for the opportunity. And I hope that my story could kind of inspire others to one day do the same, and find breakthroughs in their own trading as well.
Yeah, I'm sure it will. And congrats on your performance, not just this year, but last year as well. And also congrats. I know you just took up a new position as a portfolio manager, so that's got to feel fantastic too. So congrats on that. And let's kind of dive right in. So I always like to hear about how people kind of begin their journey. And I know it's going to be an interesting, path along the way that you'll lead us through, but take us back to the very beginning. How did you first get interested in the markets? and investing in trading, and have that be a career that you wanted to pursue?
So kind of a little bit about myself in terms of my trading journey. Like, I first was, was in touch with the markets late in 2019. So that was my second year of university. And back then my mom gave me a sum of money. And so she told me to go and buy this stock called HSBC Holdings. So it's a bank. It's listed in the Hong Kong Stock Exchange. And first mistake as a trader, right? Like, you don't take tips. And that's exactly what I did. I took tips. And so I bought HSBC Holdings. And so this was the time frame of where I bought it in late 2019. And as you can see, first of all, it's in a stage 4 downtrend. Price is below, pretty much most of the moving averages. It's most importantly below the 200-day simple moving average, which is the red line. And so that's what I bought. And for a brief period of time, I actually saw a profit. It actually kind of, went up in price a little bit. And when I was looking at my unrealized profit, the first thing that I thought to myself was like, God damn, like, in a brief period of a couple of days to a week, I could make potentially, what an average, person would make, if they were working in a day job. And that seemed very enticing and attractive to me as a university student. So the main motivation to get started was money. And obviously that didn't turn out very well because, COVID hit and you saw what happened to the stock. It just basically crashed and I had to sell it at a loss. But that was kind of what sparked my curiosity in the markets to begin with. Thereafter, kind of what happened was, because I was also studying an economics and finance degree at the time, so, everything was quite related. And so I decided, like, you know what, I'm going to kind of go to the bookstore and look for a couple of books, right? So, and so these were the first couple of books that I bought. Some of them were classics. So you have the Market Wizard series, which is great because you get to see how all these great traders, how they approach the markets, what are some of the best practices, and through these books, I subconsciously, I think I stumbled onto trend following, and I think it was one of the chapters by William O'Neill that really kind of that really resonated with me. And then, so the other books that I bought, the other one is Trader Vic. So you interviewed him, I think, last year in a TraderLion conference. I think that was awesome. And this book left a very, very big impression because one of the main lessons that I kind of took away was that in trading, you kind of always want to conduct your business in the following order of importance. And it has to be one after the other. So the first is always preservation of capital, because if you run out of money, then you have no money to play with. And then, so once you get that down and you could focus on preserving your capital and keeping your losses small, that's where you can try and go for consistent profitability. So like, kind of treating trading as a business, you go for these small wins, and over time they kind of stack up and they give you a big return at the end of the year. And then the last thing is, once you've hit the first two and you've built up a cushion for yourself, that's when you have leeway to go for pursuit of superior returns. And so that particular chapter in that book left a big impression. And then, as a student, you kind of think that, you're being taught efficient market hypothesis. So technically, you can't outperform the market. That's what the theory kind of concludes. But then this book, The Universal Tactics of Successful Trend Trading, the author, he actually proves statistically that the markets follow a non-normal distribution. And what that means is that markets are actually not efficient. And so that actually gives us, opportunity to significantly outperform the markets. And so these were the first three books that I kind of bought and read following that episode, kind of watching the first stock that I buy go down the drain, which sucked. And so that kind of kickstarted my journey trying to be a trend trader. And so then this was kind of what happened after that. With COVID, massive QE, and then basically what happened was global markets entered, a huge raging bull. And at that time, I had no idea what I was doing in terms of what was the dominant fundamental factor that's driving the market higher. All I knew was, okay, I see this very nice chart pattern. It's setting up according to what I've read in the books. And so I'm going to take this stock long. So, this stock, for example, in the Hong Kong Stock Exchange, S'more, they do electronic vapes. And it just IPO'd, it went on a huge run, and it began to consolidate. And so you could see as it was consolidating, volume was drying up. And then, so another example, the first stock that I bought in the US market was NEO. And to me, this was a pretty textbook model book stock in 2020. The mistake here that I made again was it was from a friend's tip. He bought it, I don't know, in the low $2, $3, and then at $12 he's like, hey, buy NEO, and so then now that I look at it, I realize that it's been forming kind of VCPs and consolidations. Every time there was a move expansion to the upside, all these consolidations came on lower volume, which kind of signifies that, supply isn't coming into the market. So when there's a pickup in demand, it doesn't take that much to drive price higher. It was also in a leading theme at that point of time, which is electric vehicles. And obviously, the liquid leader in the 2020 bull was Tesla. And so then you have NEO, you have Li Auto, you have XPeng, all these Chinese autos. They were going higher in sympathy as well. Basically, my mom gave me $200,000, and I turned that into $1 million. So as a third-year university student, I had $1 million. And kind of looking back at the time, that was too much money for myself to handle. I really did not know what I was doing. And so it was kind of that unconscious incompetence and riding that market environment higher that kind of led me to my first pot of gold. And so then here came the first setback. So the Hong Kong and China equity markets actually topped ahead of the US markets. It happened after Chinese New Year. And that time, with $1 million, I thought that, okay, I feel like I could be the next market wizard, and let me kind of try something else. So I became an investor in BABA because I saw that price had kind of gone so much higher, previously, and now it's kind of gone down so much. And I think back then there was news of, the Chinese CCP government, they were trying to crack down on big tech, and that was what caused BABA to go down so much. And in my mind, I was like, okay, it's gone down so much. It surely must be a bargain, right? And obviously it isn't. So I began buying, somewhere around this consolidation right here. And obviously it was not a consolidation. It was a stage 3 top kind of breaking down into stage 4. And as it continued to go down, I did not sell out of it. I had no stop loss, and I just averaged down. And I averaged down, and I averaged down until I couldn't take it anymore. And then I capitulated. I sold out of it. And at this point in time, that was when I kind of decided, I will not be an investor anymore. It's simply just not my personality. I don't have what it takes to kind of ride it out. And kind of what I've been reading from all these trading books, this is not the right way to do it. And here I kind of also broke a rule, right? I bought a stock that's trading below the 200-day. And so this was a pretty humbling moment where I kind of realized, okay, I probably don't know what I'm doing. And so after this loss, I, under the advice of my wife, I wired out a huge chunk of my money. And I was kind of restarting again, let's try again and see, and see, continue to learn. And once the Hong Kong equity market top was when I began my foray into the US markets, because there were still opportunities there. So I was trading I continued to follow the same principles. I was looking for consolidations on volume dry up, and then I was betting on a continuation move. So Upstart was a very memorable one because I distinctly remember Mark Minervini going on CNBC, and I think it was a joke at the time. It was like, I can't hear you, and what? So that happened. I thought it was pretty funny, but this was very memorable because I was buying Upstart throughout this entire consolidation, and obviously I think it was earnings that kind of propelled it higher, and I kind of rode this climax run, and then AMD in of 2021 as well, as the U.S. markets began to top. This also began my first foray into options too. So I was buying calls in AMD, and I was like getting these crazy gains. But obviously, the bear market hit, and I had no idea, right? So this was a very humbling moment because what I was doing at this point of time was I was buying stocks in a downtrend. And although I was kind of sticking to stopping out when, the stock goes against me, I was suffering a death by 1,000 cuts. Mm-hmm. And that was kind of slowly drawing my equity curve lower and lower and lower. And that was a lot of pain. And not only that, it wasn't just the financial capital aspect of it, but as I continued to trade this downtrend and going against the tide, I was draining myself mentally and emotionally as well. I began to get very frustrated, and I began to commit mistakes that I guess every trader who goes through this journey would commit as well. So I began to trade very emotionally. I would stop out, but then I would kind of convince myself that this trade is not over yet, and I would put the trade back on, but with double the size. I would also kind of risk my money into economic events like the CPI and the PPI, which, if from my memory, it contributed to huge gap down days in this 2022 market. And things were just not working. And so then I began to think of if I can't make money going long in a downtrend. So the first book was Trade Like an O'Neill Disciple by Gil Morales and Chris Catcher. And so that's a continuation of, in my view, it was a continuation of How to Make Money in Stocks by William O'Neill, where they brought kind of the principles from how to make money in stocks and kind of advanced it into the modern era with their own techniques. And a follow-on to that was shorting with the O'Neill disciples and taking advantage of the downside. And so that kind of made a lot of sense to me. And it was in this year where I subscribed to the Gilmore Report. So I was a member of Gil Morales' newsletter at the time. Now it's called the Owl Report. And I began to kind of read through all his posts and kind of thinking about, just reading about how he thinks about the short side and how he approaches it. And so I began to learn short selling. And it was towards the final quarter of 2022 when I began to make progress shorting stocks that were rejecting moving averages. They were obviously in clear downtrends. And I have to say that being short stocks and seeing profits come, it's much more intoxicating than being long. And that can kill you if you don't know what you're doing. So kind of knowing very little can be very dangerous as well. And that kind of set me back because when the market bottomed in late 2022, it was in October of 2022 when the market bottomed, I had no idea. And I was unaware that the market bottomed. So going into 2023, my impression was that all these stocks recovering off the bottom were dead cat bounces. And this was kind of my biggest drawdown that I guess you mentioned, and I kind of mentioned it on X as well, which kind of almost caused me to give up. So it was Tesla, and kind of treating the bounce in the first quarter as a dead cat. I first began to short Tesla when I saw it trading near the 20-day exponential moving average. So this is the purple line. And I was thinking, oh, look, it's bouncing into moving average resistance. I should short it. So I shorted it, and it did not work. I got stopped out immediately. And so I told myself, okay, probably the market has more to go before it finds resistance and everything will roll over again. And so I watched Tesla trade higher and higher and higher, and I saw it trade near this kind of mini left side peak. And I thought, oh, double top short sell. Let me short again. And this time I doubled up in terms of my risk. And then I got stopped again. And so I got very frustrated. And I guess this frustration kind of carried on from, being so beat up in 2022 that I began to look intraday on a 5-minute chart. And I was basically full port risking my account, shorting this consolidation, thinking that every pump, pump higher would get rejected. And this was a very, very, very bad time because I was obviously overtrading. I was revenge trading. I was on tilt. And I was kind of trying to time every single take on that 5-minute chart. And it was very, very bad. Before I knew it, whatever money I had left, I drew down 60 to 70%. And so, when I finally gave up on shorting, I took a break. I distinctly remember sitting at the condo pool, kind of really out of it, and I couldn't bear to tell my wife that I was down. I drew the account down by 60 to 70%. And at that point in time, so I had graduated, I was working in a job, and I had thoughts of giving up, and I didn't know how I was going to recover from that drawdown.
I think a lot of people can relate to this, so this is good.
So yeah, it was a very dark period. I still remember it very vividly. My wife she kind of knew that, something was wrong. And she asked me that day, like, are you okay? But I couldn't bear to tell her that, I had hit such a big drawdown, just kind of revenge trading and being on tilt. And so thereafter, like, I took a break. I think it was a month or two off trading. And I kind of contemplated whether I should give up and whether this was for me. But kind of, spending that time away from the markets and kind of reflecting on myself, thinking back on that whole journey, beginning from, late 2019, and kind of seeing myself work in my day job, I couldn't envision kind of giving up on this and working a day job for the rest of my life and just being mediocre and normal. It's not in my personality. Just being someone who used to be a former athlete as well. Like, I did not want to give up. And so, basically what had happened after that was, I began to really take the time to study and read all these books, and through your TraderLion interviews as well, like studying all these top traders. And so then kind of going back a little bit here, some of the folks that really heavily have inspired my trading, Mark Minervini, Gil Morales, Christian Kulamagi, Jeff Sun, Oliver Kell, and of course there's more. So like Leif, and all the wonderful traders on X that I've picked myself up. Yeah, so basically what I kind of begun to do, I was looking at Christian Kulamagi's website, and he's like, you have to study how all these stocks move, right? How they set up. And I began making my own model book. So I started tracking all these stocks that had moved, made a big move, consolidated, made a big move again. And so I began making my own model book and making my own annotations. So that was the first thing that I did. The other thing that I did was I began coming up with a set of rules. And so it's a document that kind of outlines how I should engage in the market, what I can do, what I cannot do. So let me kind of open that up as well.
And for the first few years, you didn't kind of define your trading rules yet. This is kind of the first time that you sat down and defined for yourself kind of your system. Is that right?
Exactly. So yeah. Oh, so that's a good point. So kind of rewinding a bit, going back, I had kind of concepts that I was working on, like trading consolidations in an uptrend and then getting out if it doesn't work. But I had no rules to kind of govern myself. Because trading, I realized kind of looking back and reflecting is it's as much mental as it is technical. So kind of, I'm going to digress a little bit, but, on X, when I see a lot of comments like, oh, how do you approach this stock? How, where do you buy? Like all these questions are very technical. And I very rarely see questions that are kind of more on the mental side. Like, how do you handle those drawdowns psychologically? What do you do? Personally, I do think that the technical side of trading can be learned. There are a lot of resources out there, including you guys. I think it's the mental aspect of it that people should also pay attention to as well. And so kind of going back to I made a document, right? Like kind of outlining what I should do, what I can't do, what I'm looking for, what are the setups I trade, how I manage my trades. And so I began to make this document. And so then I began trading again after that time off. And I guess luckily was that 2023 turned out to be a bull market. And so I had begun to work my way up. And then going into 2024 was when I thought to myself, like, hey, I actually could go on big runs when the market environment is favorable. And, I could make big returns. So why don't I join the 2024 US Investing Championship and kind of test myself? So first is to test myself. Second is to keep myself accountable, because when I put my results there in front of everyone, it acts as a accountability measure, right? And so I felt like I can't screw up in front of people. And then, so that was what happened. And kind of looking back into 2024, it was a good year, but then could I have done a lot better? I think I could have. In 2024, although I ended up the year 80%, I made a few crucial mistakes as well. So I did have a bout of kind of revenge trading or overtrading towards the middle part of the year when things got choppy. So this was prior to the yen carry trade crisis in August. And so then from January, I think it was until May, year to date, I was actually up, I think 70%. And then thereafter, in the following months, I began drawing myself down because the market environment got very choppy. And back then, I was risking, 0.5% to 1% of my capital per trade. And so you can imagine what that does to an account when you kind of cut yourself and incur a losing streak. And so I was drawing down fairly quickly to the point where I was almost flat for the year again. And that really, really sucked. And so then this came the second turning point, which was when I met Christian Flanders. He came visiting in Hong Kong and he reached out to me on X. I'm like, oh shit, Christian Flanders, he's at the top of the leaderboard and he wants to have dinner with me. Cool. And so we had dinner and I kind of spoke to him about, what I was going through. I lost traction in my trading and, I'm still kind of booming and then busting. And the equity curve was just way too volatile, even though I was making progress. And so then he told me, cut size. When you start to see yourself losing, you cut size in half, and you cut size in half again, and you cut size in half again until you find traction. And the other thing that he told me was, on every month, he did a loss adjustment exercise. So hypothetically speaking, if you change all those negative months to minus 5%, what would your eventual return be? And so I did that loss adjustment exercise, and I got back to him on chat, like on WhatsApp the other time, or it was Telegram, and I was like, shit, Christian, you're right. I need to do my best to stop myself from drawing down. And so then from that point onwards, I became very aware of my last 5 to 10 trades. And if they're all losers, I'd be very, very cautious. I'd size down a lot more. And And so then I kind of brought that mindset going into 2025, where I felt like I didn't do as well as I like in 2024, and I was not happy about it. And so let me join that 20K division again, and let's see if I could, right my wrongs and keep those drawdowns small. And so for the most part of 2025, I was able to do it, with the exception of December. So I'll talk a bit about what happened in December. It kind of sucked, and I guess it was kind of like an awakening moment for me as well, like a reminder. So I'm kind of hitting, a little bit of a roadblock again.
Hey everyone, just want to hop in real quick for a word from our sponsor, Public.com. Support for the show comes from Public.com, the investing platform for those who take it seriously. On Public, you can build a multi-asset portfolio of stocks, bonds, options, crypto, and now generated assets, which allow you to turn any idea into an investable index with AI. It all starts with your prompt, from renewable energy companies with high free cash flow to semiconductor suppliers growing revenue over 20% year over year. You can literally type any prompt and put the AI to work. It screens thousands of stocks, builds a one-of-a-kind index, and then lets you backtest it against the S&P 500. Then you can invest in a few clicks. Generated assets are like ETFs with infinite possibilities, completely customizable and based on your thesis, not someone else's. To learn more, go to public.com/TraderLion and earn an uncapped 1% bonus when you transfer over your portfolio. That's public.com/TraderLion. This was paid for by Public Investing. For full disclosure, check out the description below, and we've got a link right down there for your convenience if you want to learn more about public.com. Thanks for your support, and we'll be right back. All right, Clement, I know we were going to talk through your kind of overall stats. I'd love to kind of hear how you break it down both month to month, as well as kind of your overall stats as well for the year. So let's kind of dive right in, and it'd be cool to see kind of your most important takeaways. And I know focusing on minimizing those monthly drawdowns has been incredibly powerful for you. So I'd love to kind of see how that takes its own effect in reality. So let's dive in.
Yeah, sure. So this slide kind of like encapsulates, my stats for the year. So I kind of think about it, when I look back at this in two ways. So the first thing is, kind of looking back at 2024, although I was able to achieve a, pretty decent return by the end of the year, about 80%. But I to me, that felt like a massive underperformance, because, when I kind of did a loss adjustment exercise and kind of capped all those monthly losses to, say, for example, less than 5% on a month-to-month basis, my return would have more than doubled. And so then coming back into 2025, I had a goal for myself where I put myself in the mindset of, I don't want to be thinking about making big returns, but I want to be thinking about how I can minimize my losses, on a month-to-month basis, and just survive until I hit my stride. I start trading well, and then I step on the gas. And for the most part in 2025, like if you look at the table here, I think I've managed to do it quite well. Just kind of briefly walking through month to month, like from January to March, it was in 2025, it was a rather difficult period if you're only trading long side. And so then, kind of just adopting the mindset of kind of chipping up, getting those small gains where possible, being more opportunistic. And then I was able to kind of compound that into a decent return by the first quarter of 25. And then going into the second quarter, when, post Liberation Day, the market bottom was when, things got relatively easier. And then so I kind of stepped on the gas a little bit, especially during the May period. And then even when I was not trading that well, like in the June period, I was able to kind of control that drawdown to less than 5%. And then kind of July, the third quarter, July to September, was a very good period for me. I was in the zone or something, and the markets were easy. And so then I was really stepping in on the gas, and on a month-to-month basis, I was able to rack up very good returns to kind of compound that overall cumulative return. And then kind of going back into the last quarter from October to December, October was a very hot market to begin with, until, Liberation Day number 2 on the 10th. But I was just not trading well. I didn't feel in sync with the markets, but, overall, I still managed to keep that monthly drawdown small. And then November was when the short side was in play. So I managed to take advantage of that. And then also kind of, take advantage of the turn late November when the markets kind of recovered a little bit. So that was a good month. And then finally December was not a good month because, like as you can see, it was a 9% down month, and I wasn't able to cap it, to the negative 5% floor that I've set for myself. And we could speak about it a little bit more in the interview, but I think that was the month where I kind of let loose a little bit. I began to not really stick to plan and kind of oversized a couple of trades, which led to that month, that monthly drawdown. So it was kind of like another wake up call, if you want to put it that way, or learning lesson for me to really revisit my foundation, right? Like go for the preservation of capital first if the market environment is not easy, and then pursue consistent profitability, racking up those wins, and to eventually go for superior returns. So I guess in the grand scheme of things, like I'm pretty happy with the return, but as a trader, you kind of always want to strive for better. So that is my returns in a nutshell. And then just kind of glancing over my averages, so my stats, right? So for the year of 2025, I was batting about 30%. So that's my win rate. My average gain is about 5.4%, and then my average loss is 2.1%. And then for the year, I did about 1,294 trades. So it's definitely more than my previous year, where I did about 800 trades. But then from an efficiency aspect, I'd say I've done much better and kind of like reflected in my returns. And my average gain, my largest gain is about 149%. So it was one of the trades that I took in September, which was the Octo EP. And then my largest loss is 26%. And then on average, I hold my winners for about 3 days, and then I hold my losers for less than a day. So these stats are actually pretty consistent with what I saw in 2024. I've got around the same stats. I would say though that because it's an average, there were certain months where these stats were much better than others, and then also kind of out of the 1,294 trades, I've been able to back out about 500 trades which were not proper trades. So that definitely skewed the averages down. And so then kind of one of my goals for next year in 2026 is to trade much less. When I calculate the aggregate P&L for those 500 trades, which I shouldn't took, and I shouldn't have taken them for various reasons, such as there was actually no setup, but I kind of feel FOMO, so I punted it. I put a position in it and it ended up being a loss. Or, I was overtrading. So maybe it was a ticker that I bought, it stopped me out. And then I re-entered, it stopped me out again. And then I tried my luck and I re-entered one more time. So then the other 2 times, I would have considered it as an overtrading, an overtrading problem. So just kind of calculating all that in the aggregate P&L, it was a huge chunk actually. And so by removing for those 500 trades, it would have, definitely boosted my profitability a lot more for 2025. And so then I guess one thing that traders could do, right, is kind of like calculate, what your returns would be if you remove for those trades, right? Like, so kind of like one aspect of profitability is your offense, right? So like how good are you able to identify the market environment, the technical setup, and then capitalizing on it, putting size in it where appropriate. And the other side of the equation is your defense. Like how well can you keep the money that you make? It's an exercise I recommend a lot of traders do in the reviews, just to kind of, bring it to your consciousness to not make the same mistake again. So yes, this is my 2025 in a nutshell.
Yeah, I think this is a great overview and obviously a fantastic return. Congrats again. And I think you did a really great job of setting yourself up for a great year in that first quarter. Like we've talked about, and like you emphasize that you think a lot about, you build up that cushion and then you can become more aggressive because you've got that cushion to work with. And that's both a confidence thing, and of course, a capital thing as well. And I think this is just another great example of how you can have fantastic returns with, if you tell somebody, I only win 31% of the time, they're not going to think you can have an amazing, year with that numbers. But this is a great example of that in reality. So yeah, fantastic. Yeah, you mentioned a few things that you're looking on to remove those, 500 or so trades that you think were just kind of not quite part of your system. Is there kind of one specific rule that you're focused on going into 2026? And we're already in that a little bit, but is there kind of one specific thing that was kind of the majority of those 500 trades, or really they were just kind of an aggregate of different things, like you said?
I would say it was an aggregate of mostly two different things. So the first thing is kind of taking a non-setup, and then the second thing was kind of retrying too many times in a single session. And so then going into 2026, like one of the things that I've kind of implemented is, if I'm not running hot and I don't see a lot of setups, and the market environment to me feels a little bit murky, not too clear, I limit my number of executions per day to no more than, 3 positions. And for each position, I'm not risking more than 0.3% of the equity capital. So in aggregate, I'm only allowed to risk 1% of my equity capital per session. And it's not every session where I'll take 3 trades. Sometimes if I really don't see the ball well, or I don't see anything compelling, then I would not take a trade, or I would probably see something that looks interesting and it's opportunistic, then I probably just take 1 trade. So just kind of really, really slowing down as compared to like, being in that competition mindset where I'm just pushing and pushing and pushing. And then because, kind of wanting to gun for returns, you kind of put yourself in a position where you're just watching the market, and then, oh, look, this looks half decent, and then maybe I could take it and then see what happens. So that's kind of like a gambler's mindset, right? So really, with this new rule in place for me, for 2026 so far, at least, it's been a very, very, for the most part, a choppy environment, aside from, I don't know, pockets of, I guess, outlier days. I don't know how you call it. So like the 2nd of January to start the year, for example, where when SNDK kind of broke out of a perfect high tide flag, that was a proper setup, right? But then as we continue to trade later on in the couple of weeks, like you see something like a KTOS, or you see something like a MRCY, all those defense names, to me, they kind of ran straight up off the bottom. And so I just couldn't put myself in a position to buy those because that wasn't really a proper setup. And so then I kind of missed the bulk of those moves, whereas other traders probably capitalized on it. So yeah, just long story short, I kind of limit the number of executions that I'm allowed to make for myself until I really see my equity curve go up, the right side, in a straight line. And I look at my last, say, 5 trades, they've all been working for me. And then that's when I give myself a little bit more leeway. So there's a bit of discretion involved when that happens. So I probably, if I see a lot of setups, I'd be more willing to take it as long as there is a proper setup and it kind of satisfy my rules. And then the other thing is also kind of like managing other people's capital too. I'm a little bit more trigger shy psychologically right now, and it's an adjustment that I'm making. So that in that aspect, it helps as well. So that's kind of how I've been combating it so far.
Yeah, perfect. And for other traders who want to kind of do this type of exercise, analyze their month-to-month, stats, any advice for them, or aspects of post-analysis that you found really helpful in identifying your weaknesses, and anything you can kind of suggest to them to help them find, the key things that they need to work on that can really move the needle and improve their trading pretty dramatically. I don't know if there's anything, that you recommend. Obviously, calculating these stats is really helpful. But of course, going over, key trades is also something that I personally found to be kind of where the gold is, both the winners and, of course, the biggest losers.
Oh yeah, 100%. The one advice that I would probably recommend is to definitely start early. And what I mean by that is, kind of 2025 was the year for me where I did, eventually leave my corporate career. So then kind of being a full-time trader, it kind of imposed a little bit more, a little bit more pressure on myself to kind of perform, right? Like I have to tell my wife, like, hey, look, at the end of the year, we've done well. Whereas I don't want to be put in a situation where my wife asks me, so how did the year go as first time, a first full-time trader? And then I tell her like, oh, not so good. So that was a little bit of pressure in doing that, and that pressure kind of spurred me to really take my reviews very seriously. So what I mean by starting early is one thing that I found really helpful is with every trade that I log, I'd be I would go back and review them on a weekly basis. So kind of, looking at the week's trades and then kind of identifying what I've done well, what I didn't do well, and then you can log it down in the journal. And then on each trade, you want to start tagging, right? So, which trades are mistakes and what exactly is the mistake that you've made? Which are the trades that you've kind of executed well? Look back at the chart and then ask yourself, why was it done well? Was it a perfect setup? What was the market like at that point in time? So kind of intro week, you're reviewing already, right? And then by the end of the month, you want to do a monthly write-up for yourself. So I've in 2025, I've done a monthly write-up for the most part of the year, every month, kind of consistently, and I've been posting it on my account on X. And in doing so, you kind of really take a step back, right? And then look at the market and see how you've kind of performed against your opportunity set. So aside from the things that you've done well and you didn't do well within that month, you also kind of want to look at, so what are some of the opportunities you missed? So for June, for example, two of the biggest opportunities that I missed was in coin and in CRCL, right? So one was a breaking news type of catalyst. So it broke out after a piece of news came out. I forgot what it was. And then CRCL was a new hot IPO, which was also part of the whole crypto theme. Kind of looking back, I would chart where I would probably, buy this, kind of looking back in hindsight. So it's good practice as well. So doing it on a month-to-month basis helps. And then because you're kind of chunking it, that's when it becomes easier to do that year review, right? And to identify that, oh, I have 500 trades that weren't supposed to be taken. Because like if you're going to do a one shot at the end of the year, it's going to take a lot of time, right? So
Yeah.
it's really starting early and managing your time well, treating it very seriously as a profession will definitely help.
Yeah, I like that a lot because, like you said, if you leave it all until the end of the year, it's going to feel like this huge task. It's going to take a lot of time, all at once. And like you said, doing that work month to month helps you stay in tune with the market. And am I trading well? Am I seeing the ball not well? And make corrections accordingly. Yeah, Clement. No, thank you so much for walking through that. I want to kind of go back to one thing you mentioned because I've kind of made this observation with a lot of the top traders I've interviewed is they're either former athletes or former gamers, which I think is just kind of interesting. What kind of sport did you play, and how do you think that how do those lessons taking from kind of athletics do you think impact your trading and curious to see if you see any like strong parallels between sports and trading as a whole.
Yeah, that's a good question, Richard. So in the past, I played competitive basketball. So I was really passionate about it. I grew up watching Kobe. And then thereafter, people don't believe me, but I kind of called out Steph Curry before Steph Curry became Steph Curry. So I was watching him play with Monte Ellis. I think it was back in 2013 or something. And when I saw him play, it was like, for me, I'm 5'7", 5'8", if I'm pushing it with shoes. And so then kind of watching a smaller guard play that way was very inspiring. But kind of going back to your question was, yes, I do see a few parallels in athletics that applies to trading. So kind of the first thing is just, having it's the mentality, right? So not giving up when times get tough. And also kind of, respecting and trusting the process and trusting the journey. As long as you kind of put in the work and continuously grow, as an individual, as a trader, as an athlete, whatever. So just kind of give you an example, like when I first started playing basketball, I was a terrible shooter. I just couldn't make a shot to save my life in a competition. But then it's just putting in the reps every time on your own in the basketball court, every time, after basketball practice, putting in the extra shots, working on your form shooting, right? So form shooting has parallels to progressive exposure as well. If you can't, if your body is not warmed up to shoot a 3-pointer, then, you should start closer to the basket. So similarly, if you can't even make money risking 0.2% of your capital per trade, why are you risking 1%? So there's this whole concept of kind of form shooting, working your way as you find success, as you move back, towards the 3-point line. It has parallels to progressive exposure. Going back to trusting the process, trusting the journey. As I continued to play throughout the years, I got better at shooting. And so similar to trading, as I continue to watch the market trade and of course, trade the markets and seeing these cycles over and over again, I got more familiar with how things worked and when I should be a bit more aggressive and when I shouldn't. The signs are all there, and I could go through it later when I review 2025. There definitely are parallels. The biggest one for me is the one with mindset, kind of watching Kobe. So I used to kind of do these kind of 5 a.m. workouts before school. So like people call me hardcore or whatever, but I kind of like it. The whole discipline aspect as well. Picking your spots when you shoot. Not forcing a shot, so not forcing a trade. All these kind of apply. But yeah, and also at the same time in the basketball court, you're not going to make 100% of your shots. Your batting average is probably going to be at best 40% if you're a very good 3-point shooter.
Yeah.
So same with trading, as a swing trader, you're trying to ride trends for as much as possible. Your batting average is going to be about 30 to 40% as well. So there definitely are parallels that I really appreciated. And just having that mindset of not giving up and just going, toughening it out when times get rough was some of the biggest parallels that I see.
I love the Kobe stories where some other player asked to work out with him, and they're like, "Oh, I'm working out with Kobe. I gotta get to the gym early. He's gonna get there at 6. I'm gonna get there at 5 and beat him there." And then it turns out he was there at 3:30 a.m. He's gonna beat them or whatever. That's my favorite thing. Do you have any favorite kind of Kobe tweets or kind of stories that that you know of that kind of inspire you or just kind of ones that you love just in general? Because I think the Mamba mentality, there's so many parallels to trading. I think he's like a market wizard worth studying regardless of your domain. So do you have any favorite Kobe tweets?
Yeah, I think it was the one that you just mentioned. So I remember reading about it. I think they were in China. I think with Team USA, and people were going out, to play. And I think there were some players that decided to go to the gym as well to work out, and they already saw Kobe there, finished with his gym workout in a full sweat and things like that. So it was all these kind of things. And when you watch, Kobe highlights, there was a video of him, he dislocated his finger, and then he just walked off the court to the bench and he just popped it back in and he went back to the court and started playing. It didn't hurt at all. It's all these kind of things, and also kind of watching him play, the expressions that he puts on his face, just that toughness in him. And then even post-retirement, kind of venturing beyond basketball and watching him be successful in that aspect as well. It tells you, you never want to stop learning. And again, parallels to trading, you never ever want to stop learning. Just because I had a great 2025 doesn't mean that I'll have a great 2026, because, there's always this whole concept of edge erosion. What if what I'm doing doesn't work anymore? And so then as a trader or as a basketball player, you have to continuously reinvent yourself. If you look at basketball, it's now an era where people like to take fast shots, go on a fast break and shoot a quick 3. But, 10, 15 years ago, it was the era of the big man. You want to dump it down to the low post and let the big man do their work. And now if a big man can't shoot a 3-point shot, he's out of the league. And so then, there's so many parallels. But yeah, yeah, just I digressed.
Yeah, no, I think it really applies. And like, I think with Kobe, the concept of putting in the work and like just being so prepared, there's a big parallel with the work you put in with the model books and building those for yourselves. And that's how you actually learn the nuances and develop your edges, develop your feel, just like how a basketball player would develop his shot. You're developing your feel for reading charts and identifying entries, exits, how much you should size, and when. So I think there are a lot of some great parallels there. And if polymarket was a thing, you should have bet on Steph Curry becoming Steph Curry back then.
Yeah,
I think you could have
right.
done pretty well. You could have done pretty well. But no, this is fantastic. And I think it's always great to hear about people's backstories. And like I said before, I think you've certainly had your ups and downs. And I think a lot of people watching this can relate incredibly to that. And especially a lot of boom and busters, which, I think it was really great that you got to chat with Chris and focus on those monthly drawdowns, because I think that's key for boom and busters. And for everybody watching, if you haven't watched my interview with him, I think that's a great one to watch after this one. Finish this one. Go to that one after. Because he's done a lot of cool things, like doing a study if he held until it broke the 21 EMA, how would his performance change? There's a lot of small tweaks like that can dramatically improve your performance by, like you've talked about, like letting the stock work and, building in that asymmetry that we need as trend followers to, with the 30% batting average, we have to let our winners run to make it mathematically make sense. So Clement, I'd love to kind of dive deeper into, your trading style and, some of the key trades of your 2025. Do you mind kind of just setting the stage? How would you describe yourself as a trader, your overall style? Obviously, you've had different influences that all, trade in a similar way, but with different time frames a little bit. So how would you kind of define the style that you currently use, here today?
Right. So I guess, like, if I were to describe it in a sentence, is that kind of Mark Minervini, Gil Morales, Oliver Kell, and kind of Jeff's son had a baby. So I'm a hybrid of the four of them mostly.
Yeah.
And so in terms of what I look for on the long side is I really look for that volatility contraction. But in the context of, an Oliver Kell price cycle where I want to see a stock wedge pop above the 10 and the 20 day. And then I want to see it check back into the moving average and begin to base. And so that's kind of the main setup that I look to buy. And then on the short side is it's 100% Gil Morales. So I'm trading kind of late stage failed basis. And what that means is I'm kind of watching a stock violate that 20-day exponential moving average. And I want to see a wedging type of price action on low volume into the moving average. And I'm timing that intraday as it reverses. So, you see a lot of people talk about the H pattern. It's quite similar. Or Leif talks about the bounce and roll. It's quite similar. And so that's kind of how I would describe my trading. And so kind of rewinding a little bit, in 2024, I traded one pattern only, which was, that kind of Mark Minervini low cheat or Oliver Kell basin break. That was one pattern that made my returns. And then coming into this year, was when I began to kind of pull everything out of my playbook of what I knew, and suddenly it just culminated into this. So it was a surprise for me as well, that things worked quite well, and yeah, I could go through a couple of trades, and actually what I've done is I've broken it down month by month, just to kind of bring you through my thought process and how I approach things. So let me kind of hear my
Before you get into the details, how much of your trades are to the long side and to the short side? And obviously it depends on the opportunity set of a given year, whether you're going to favor one or the other, but how much of your profits, at least this year, were to the long side versus to the short side? I think that might be helpful for people watching.
Yeah, that's a good question. So actually about 70 to 80% of my profits came from the long side, and then the remaining on the short side. And, it kind of makes sense as well because, for the majority of 2025, we've predominantly been on a bull market, right? Yeah. From April all the way until the end of the year. And when you're kind of trading the short side, when, the market is in an uptrend, it's much more challenging. You have to be much more nimble and much more focused to know when to take your profits. And I'd say the bulk of my short side profits came during that February till April period, prior to Liberation Day. And so then, it was fun, and I'll go through it, but it's about 70-30.
Yeah, cool. No, that's good to hear. Yeah, let's go ahead and dive in and walk us through this. And I know people probably have questions about sizing and stops, so we'll get into the details too for these. So yeah, take it away.
And so I would say I navigated January pretty decently. So this was this was one of the bigger trades. So NVIDIA was basically, kind of chopping together the market, right? And here it kind of double topped, and kind of thinking that, a former market leader starting to trade very poorly. The RS line is no longer in an RS phase, so it's begun to chop. It stopped respecting, these key moving averages that it used to do at the beginning of 2024. When it double topped, that was my basis to go along the SQQQ because of how NVIDIA had such a big weight in the index.
Right.
And so this is kind of how I time my short selling. So with the inverse leverage ETFs, I'm always trying to time an inflection point. And so I took SQQ long on the 5-minute opening range high. And I think it was, I risked like 0.5% of my equity per trade. So you can imagine with that type of a stop, the kind of size that I was able to put on. And very quickly, I was able to kind of de-risk the trade at a couple multiples just because of how big the size was. And so this is kind of what I want to see when I trade the inverse leverage ETF. So first, it broke the 5-minute opening range highs. It began to trade above the intraday VWAP. When I look at the 620 period MACD, it began to cross and start to trade into positive territory. So that kind of indicates to me that there is positive momentum in this security. And I also saw a lot of volume coming in. So there were definitely people buying this. And I was part of the buying.
Jumping in, was your entry on that second 5-minute bar, or was it after it pulled back, reclaimed the anchored VWAP? And
it was on the second 5-minute bar.
Second 5-minute bar. Stop at the low of the day or high of the
low of the day.
Low of the day. Gotcha.
Yeah.
Cool.
So like for a very tight stop, I was able to pile on a big position size. So from a risk reward multiple perspective, it kind of moved the needle and made the difference. And so I kind of sold it 2 sessions later. And the basis of selling it was, kind of going back to January being chop, right? When I study Gil Morales and how he shorts, all these prior, left side lows, they can be treated as undercut and rally areas. And so that for short sellers is a basis to cover your short. And so kind of being nimble, I covered it because to me, potentially, it was a UNR spot. And then, shortly after that, we realized that, yes, it was a UNR spot. So that was a quick kind of 2-day scalp or 2-day trade that moved the needle. The other one was, despite the market, kind of chopping in January, we did still see, some stocks still setting up. So GEV, I think the power generation stocks was one of them. Like you had GEV, you have CG, VST, and GEV was forming this really nice flat base and resisting the chop for the most part, that was happening. And so then I was kind of watching it from this flat base, and I missed this first bar through the flat base. But then, when it broke out, it began to form a high handle just above it. And so I got long as it found support on the high handle. And then I was selling it into strength really quickly. So, kind of selling 25% on the way up. And so then, I think 2025 January was when a lot of people got hurt by DeepSeek. I was affected too, but just because I was following game plan and being more aggressive to sell into strength, I was not hurt as much. So GEV was one of the other ones that kind of moved the needle. And CRNC, this one was very memorable because so this one moved up on a partnership with NVIDIA. And so this was an episodic pivot to me. And I remember this very distinctly because the day after I saw Ray post his 100% P&L. I think it was like a couple of days into 2025, and I was super amazed and inspired. But yeah, so I digress. But this was kind of how I timed the entry as well. So I did a 5-minute opening range high. I bought it on the third bar as it broke higher, with my stop at the low of the day. And then, so a couple of nuances here. You definitely want to see volume come in to kind of validate that people wanted this stock. And then kind of for me, I wanted to see that the intraday VWAP was, trading below price. So price is trading above the intraday VWAP. And of course, the 6 and 20 period MACD is kind of trading into positive territory and also crossing. And so this one really moved the needle because it moved so much. I think on that single day, it moved almost 100%. And so then I was selling the strength the next day and the day after when it broke that Friday lows. Just kind of following plan and being more nimble, selling into strength quicker to kind of build that progress in January. Because kind of going back to the principles that I mentioned, right? Like as a step one, first of all, you want to preserve capital. And then step two, you want to go for consistent profitability. And so that was my mindset. I'm trying to go for that in January, especially kind of considering the market conditions.
Was this one of the first of the NVIDIA partnership theme gap ups or like OpenAI? Was this one of the very first? I forget. I mean, obviously that was a theme kind of throughout the year where it would cause these nice moves, and the earlier ones were maybe a little bit better than the later ones. But yeah, I don't know if this was the first or just kind of one of many, but yeah, this is a memorable one. And yeah, what a strong stock.
Yeah.
And this is more of an episodic pivot trade. Are you looking to be much more aggressive and sell these into strength like you did the 2 days after versus a VCP type trade from a base? Because these are more a momentum play than not momentum play, but more of a trending play if it's a VCP buy versus this is more of an EP. Do you make that distinction in your mind with your sell rules?
So to be honest, I don't really have that distinction yet. It's something I'm kind of figuring out. But like off the top of my mind, it's I think there's also a need to kind of differentiate between the type of company that is kind of benefiting from the EP. So kind of Cerence, for example, it does not strike me as a company that you'd want to hold for a multi-day move. Whereas something like an MP, for example, this year, when I think it was some government involvement, I forgot what the news was, and it gapped up on the EP, that's something that potentially had game-changing impacts to the company's fundamentals. That's something you probably want to hold for a multi-day move. So, yeah. So kind of digressing a little bit here again, 2026 EPs is one of my goals to kind of focus on as well in terms of expanding this setup into my repertoire, because it's a setup that I don't take very frequently, just because I haven't done enough work to build the conviction to trade it. But, occasionally when I see something that seems very, very obvious, it is something I would take.
Yep. And then can you go back to the Gev trade just very quickly? Sorry to make you jump around.
No worries.
Because I joined you. I either bought the day before or the same day you did, but I didn't sell it as well as you did, and I got hit relatively hard on the gap down. What was your actual entry on for this trade? Were you buying it kind of in anticipation as it formed that high handle, in anticipation of a breakout higher, or what were you kind of watching to regards to your entry as well as kind of your stop on your entry day?
Right. So like I was buying this in anticipation that I was going to break higher, just because of like I was looking at the prior 2 days. It kind of printed this what do you call this, doji bar, right? So kind of what happened was it opened the session, it kind of traded down into the 10-day exponential moving average, and it bounced, and it did it again. So I was kind of thinking that, okay, if it gave me an opportunity to kind of buy it off the 10-day exponential, I would do it, and I would set my stop below the kind of that blue line there, which was the flat base breakout. And so then I was buying that and risking against the line, and then it followed through. So as it followed through, I was kind of selling into strength because like I was able to get like, you know, a couple multiples of my risk in that manner. And so then I was happy with that, and I was just kind of degrossing and de-risking as it continued to trade higher.
And for your kind of sells into strength, how do you kind of determine when you do so? Is it more of a feel thing, or is it based on an ADR move from your entry? Is it based on, you know, an extension from a moving average? I know Jeff's son is an Influence, and he's got his fantastic, you know, 10 ADR from the 50 SMA, I believe. So yeah, how do you kind of decide when to sell into strength? Because often, you know, we don't want to sell into strength because it's working for us, it's going well. But like what happened here with Gev, it protected you, and you got a good trade out of, you know, something that ended up with a pretty significant gap down well back below your entry. So yeah, how do you kind of decide personally when to actually make that sell to strength to lock some in?
Yeah. So as a general rule of thumb, and this is something that I kind of picked up from Mario's in his interview when I kind of rewatched it a couple of times. So my first kind of sell into strength rule is when my unrealized profit is about 2 times the ADR of the stock. So the average daily range of that stock. So say, for example, if GEV's ADR is about 4% and my unrealized profit is at 8%, I'd take a third off. And then basically what I would do is I would shift my stop to break even. And then my second tranche, so my second third would be sold, you know, as you mentioned, Jeff's son, once I get 8 to 10 multiples, you know, of ATR from the moving average. So when the price is trading at 8 to 10 multiples ATR from the 50-day is when I'll take the next third off. And then what I would do with the last third is I would try to sell it into weakness. Now this year I've done a very mediocre job in doing that, and I still tend to sell the strength. So that's generally how I approach my sell rules. With January though, it was a little bit more of a feel thing because I was just trying to be a little bit more cautious and very cognizant of what the price action was telling me. And so then I was just acting on my instincts, and also just trying to grind out the risk reward game, kind of getting a couple multiples. Yeah, and to build up that cushion.
Yep. Perfect. Yeah, sorry to make you jump back here, but I think that's great to dive into that.
No worries.
Yeah, perfect.
Yeah. And so then these are the winners that moved the needle. Now I'm going to go through a loser. In January, I got hit pretty bad by silver. So, you know, we all know that precious metals was the leading group of 2025. From a year-to-date, you know, P&L standpoint, I think they kind of staged the biggest moves. And so silver came on my radar after buying gold, because gold kind of emerged out of a similar pattern. It kind of broke the descending trend line. It kind of formed a low cheat. So, you know, we talk about the Oliver Kell wedge pop, and then it checks back into the moving averages and begins to base. And so silver was doing a similar thing. Now, the mistake here that I made was I bought it in anticipation that it was going to break out. But the thing with precious metals is you always want to buy this on weakness. It's just the character of commodities. It's much better to buy it on weakness.
I hate trading them because of that, personally.
Yes, exactly.
Yeah.
And so then not only was I buying this in anticipation, I was also not buying it on weakness. I even oversized this trade. So I was risking I think it was 1% of my capital on this trade just because of my conviction that it was eventually going to go higher. And then I got whacked. The next day, it just kind of flushed all the way down. And it looked very scary at that time. And I was selling it and I was getting slippage because, you know, I think it was the overnight market. And this hit me big. And so this set me back a little bit, even though I was able to end the month about 7% up for January. But yeah, this was it was a very poorly timed trade. You know, chalk it up to discipline. I need to have more discipline. And, you know, kind of if I had bought it correctly, you know, if it flushed the 200-day, it begins to reclaim. It reclaims the other moving averages. If I bought it here, I would have sold it here for a profit. So this is a mistake that kind of cost some of the performance in January.
And that's an important nuance to realize, that like some types of stocks are better buys on weakness versus strength, and also probably different market types as well. A choppier market, it might be is more beneficial to focus on those buys on weakness, on pullbacks against support, define your risk there, versus a stronger uptrend, a developing uptrend where everything's working. That's when kind of those breakouts are things to focus on. So I think this is a great trade to go through, to show quite a few different techniques, as well as aspects of trading that are important to learn. So yeah, this is fantastic.
Yeah. So then that was January, and then coming into February, I'm sure we all kind of believed that the Qs looked like they were VCPing and about to break out closer to the 20th of February. Underneath the surface, though, what I kind of noticed was that the price action in individual stocks remained very, very choppy. And so then I did not have a very good month in February, because like I found myself chopping myself. Like I was just getting chopped. I buy a stock, stop out. I buy a stock, stop out. And it honestly, at that point in time, I was pretty frustrated, because kind of being up little for the month in January, I was starting to draw back down towards the zero line. And that got me a little bit nervous. And then it was, kind of closer towards the end of February when the index looked like it was going to VCP. And that was when I kind of broke my rules a little bit, and I got aggressive, anticipating a VCP breakout. And so then I'll share with you some of the biggest losses for the month of February. And that kind of temporarily put my year-to-date negative, which really sucked. So let's kind of go through it. So first the wind. So gold, we kind of spoke about silver earlier on. So gold here, again, like you could see that it was it broke out of this downtrend line. So it kind of wedge popped into 2025 above the 10 and the 20-day exponential moving average. And then it began to trade. It continued to trade. It also broke out of the downtrend line. And so then I was buying it off the support of the 10-day exponential moving average. And this trade actually worked. However, I made a mistake of selling this out of panic. And this was Valentine's Day. So I'll go through why I sold this out of panic on Valentine's Day. This was very memorable. It's a good story. And it's because of this. So Surf Robotics, so we spoke about the Qs kind of VCPing, right? So as it VCP'd, I was looking for stuff that kind of held up the decline as much as possible, so stuff that kind of showed relative strength. But in hindsight, looking back, this was not relative strength. Like, it was just chop. So I bought Surf Robotics off a 10 EMA pullback buy. And so I bought it off a break of the priority high with a stop at the low of the day. And it worked. Like, I think it went up 20% that day.
Big day.
And I was stoked. Yeah. I was like, yeah, let's go, Surf. It's time to make progress again, Qs are going to break out of VCP. And then I was looking at the rest of the robotic stocks too. So I was looking at RR. I forgot there was a couple more names. And the mistake here I made was I began to pile on exposure. So I risked 0.5% of my equity capital for Surf. I risked 0.5% of my equity capital on RR. And I think there were two more positions I put on. I forgot what it was. And so then I was risking like 2% of my, equity capital on those 4 trades. And I piled on. I'm like, yeah, we're going to break out. I'm going to go on this run. And it's going to be a great month. And no, so the next day was Valentine's Day. And I distinctly remember this because, it's Valentine's Day. So I brought my wife out for dinner and a movie, right? So we're going to have a romantic moment. And then after the movie, I checked my quotes because it was a pre-market, like 1 hour before market open. And I saw it Surf down 40%. I'm like, oh shit, what happened? And so I was scrolling news. And I saw, NVIDIA disposed its entire stake in Surf. And I got whacked. So I got hit really hard. I remember, like, it was very, very bad. And so kind of how I managed that drawdown was when the market opened, I closed out all my positions. And Valentine's Day was a Friday. So I had the weekend to kind of take my time to recuperate and look back. And this was the day that brought my P&L to a year-to-date negative. And this one hurt a lot. Emotionally, because this was also a time in 2025 when I made the transition to trade full-time. So I quit my corporate job. And yeah, this one really, really sucked. So it's a lesson in progressive exposure. You definitely don't want to pound exposure when, number one, you don't have that much cushion year to date in terms of P&L. And number two, like, my last trades have obviously been stopping myself out. So why was I doing that? Yeah, looking back, it was just greed and kind of wanting to make progress. The frustration of being chopped definitely sucked. And so, yeah, it's a learning lesson. And kind of, I'm going to hit another point in terms of trading mistakes is when you make one trading mistakes, it doesn't usually end there because it domino effects into a series of trading mistakes, which is what led me to sell gold out of panic when it did nothing wrong. And as you can see, it went much higher, right? So had I held gold, all the way, that would have probably kind of cushioned my equity curve a lot better versus if I had sold everything out of panic. So that really sucked. And then kind of going through into the tail end of February was when the VCP turned in the Qs turned into a double top,
breakdown.
A breakdown. Yes. And basically what I saw at that point in time was prior to that breakdown, you actually saw individual stocks breaking down very hard. And so to me, that was a cue to be very, very aggressively short because, from failed moves come fast moves. And obviously, kind of thinking about January to February, that whole series of chop, you could kind of treat it as, Stan Weinstein talks about stage 3. That was a big stage 3. And so then my mindset, I was thinking, okay, we're probably going to go into stage 4. And that's when I hit the SQQ pretty aggressively. So this was my entry again. Like you notice there's a whole pattern in terms of how these inverse ETFs work. So 5-minute opening range highs, trades above intraday VWAP, volume pours in, and then a 6 and 20 period MACD cross to the upside above the zero line. So indication of kind of positive momentum. And I risked, I think, up 1% of my capital for this trade. And this brought my P&L from negative back to positive. So so it's kind of like, you're had I kind of avoided all that chop and just been patient and waited for my fat pitch, this was a fat pitch. And then this was the day, this was the second entry. So again, like it traded above intraday VWAP, 620 period MACD crosses, goes into positive territory, and then volume pours in. So these were my two entries in the SQQQ. I believe this was on the 28th or the 27th of February. And yeah, that made the progress for me in February. And then so kind of like going through it a little bit more, in addition to being long SQQ, I was also short NVIDIA because if you read Short Selling by the O'Neill Disciples, Gil actually talks about how there is really no need to kind of screen for short selling setups because when the market turns negative, the former big stocks or former leading stocks will naturally be the candidates to short sell. And NVIDIA was that candidate. So I got short NVIDIA as well. Firstly, on the same day when the Qs double topped and began to break down. And then secondly was during the earnings gap up day. So that was that's another thing I can go through. Like it was too good to not take the trade. So the first entry you notice with NVIDIA was on that day when the Qs double topped, it began to kind of trade sideways and churn a little bit. You notice that the 620 period MACD begins to cross, and trade below the zero line. Price here just starts to live below the intraday VWAP. And so then I was risking against the high of day and shorting it as it broke the intraday VWAP. And eventually it worked when the market broke down. And then, so this entry here was on the day that NVIDIA reported earnings. I think there was, in addition to it being, trading into the moving averages and rejecting quickly, I remember heading into this earnings, a lot of people were very, very positive and enthusiastic about how NVIDIA is going to save the market. And so I was just kind of thinking from a contrarian standpoint that, no, NVIDIA is not going to save the market. NVIDIA is going to break down. And so when it gapped into moving average, so the moving averages, once the stock breaks down, tends to act as resistance if we go into a downtrend. And you see that at the open, it just flushed immediately. So I was trying to market order this as quick as possible with my stop at the high of day. Again, you notice a pattern, like 620 period MACD crosses lower. Volume pours in, and it's all sell volume, and it just goes all the way down. So, I do receive a lot of questions in terms of how I approach short selling, and so this is kind of how I do it. And it's slightly different from the long side because when I time my entries intraday, I can actually put on huge size to make a difference in my portfolio. So going back a little bit, sorry I'm jumping around. In terms of how I covered, so my first short here, I covered it at the 200-day simple moving average. So not only do prior price lows act as potential cover points, moving averages do as well. So I covered it, and the other consideration was that there was earnings, right? So with earnings coming into play, like it's a binary event, I don't know what's going to happen. So I got out of it and waited for the post-earnings reaction to reshort. And then eventually I kind of got out again as it traded into the prior left side low. Again, moving average price undercut and rally. It was a cover point for short sellers.
Do you adjust your stop at all before you take profits for the shorts? So for instance, for the second entry after earnings on NVIDIA, you had a big sell bar down and then kind of reconfirmation the third day. Do you place your stop? Do you move your stop down at all? Like your covering stop down at all? Or are you just kind of waiting for that undercut and rally potential area?
Yes. So I would move my stop to my entry. So at least, the worst case is that the trade doesn't work out and I don't lose money on it. And then I did not take any partials on it just because of how bad it broke down. I was, being patient for it to at least trade into the undercut and rally spot to take my full profits.
Yeah, excellent. And just looking at, could you go back to the NVIDIA chart? Just kind of observation wise, what I'm thinking as I look through these charts, your prior short entry right up against that key base pivot. So you got a key level there, market breaking down as well, kind of all aligned with that. And then the next two entries, you have the post earnings move. That's a catalyst that helps, drive NVIDIA down. So you've got catalysts with technicals all kind of lining up to make a fantastic trade. Yeah, this is great.
Yes. Okay, so that was February, and that was good because I made progress in February and I continued to build cushion, right? So going into March was when I recognized that, okay, there are no long setups at all. And so then you want to look at the short side. And if you look at the index chart, it's begun to trade below all the relevant key moving averages. And so, with March, I kind of adopted an approach where I was shorting the US market, but then at the same time, Hong Kong equities actually had a great run in February and March, and they were holding up pretty well. And so then I was going short US and long Hong Kong, and I was trading both markets at the same time. And so that continued to kind of give me progress. Now, so as an example of a trade in the Hong Kong/China market, I traded Bilibili. As the market blew apart, this actually held up quite well. You notice that it's been showing relative strength, so that's one thing. And not only was Bilibili doing very well, Popmart was doing very well in the local market too. Tencent, Alibaba were in uptrends. So you have that additional layer of edge where you have a group that is confirming in addition to that side of the market. And so I was taking Bilibili off this kind of low cheat-ish pullback buy, right? So it had a great move higher. It pulled back into the 20-day exponential moving average. This pullback, especially the last few sessions, was accompanied by volume dry up. And then so I was taking it through that pivot off that high of the day, and then I was risking it against low of the day. And given that, I had built up a little bit of cushion in February, I had the leeway to be a bit more aggressive. So I risked 0.5% of my equity capital for this trade. And then I was selling this into strength because if you flip back to the chart of the Hang Seng Index in March, although we had a move higher, the volatility of those pullbacks, the Hang Seng Index was beginning to get wide and loose. And so then I was also kind of adopting a nimble stance to just sell it all into strength to continue to build cushion, to just continue to build cushion, basically.
Yeah, and could you just define a little bit for us? For an RS phase, is that when the relative strength line is above the moving average? Is that kind of how you personally define it, the RS phase?
Yes. So when it begins to kind of trade above its own, I believe this is 21-day moving average of that RS line, and it's persistently sloping higher, is when I kind of define this as an RS phase.
Yeah, perfect. So just thinking about this trade, you've got a stock that's showing relative strength, showing momentum, performance, and then it's pulling back and tidying up right on a key moving average, a nice pivot. It looks like you used the high of the prior day as your kind of entry daily pivot, and then you had a nice momentum move that you sold into strength as it's getting close to that technical area. So yeah, that's a great trade.
Mm-hmm. Yep.
With
and then
the theme lining up too, of course.
Yes. I'm going to go back to my favorite short, which is NVIDIA. So I continue to short this on the way down.
What do you have against NVIDIA, man? Just take it.
I don't know. It was, the market was breaking down, and you look for the leader to short. That's how I did it. Okay, so kind of going back to NVIDIA, right? Like previously, we kind of covered it at the prior kind of left side low. Obviously, it continued to go much lower. So I missed that part of it, and so then I was waiting for it. So here, it kind of traded up into the 20-day exponential moving average, right? And then notice what it began to do. Like it began to H, right? So it consolidated, and then it rejected the 20-day exponential and it broke down. So I got short on this day, and I believe, let me see if I included it. Oh, there it is. And it's because of when you're short selling, you always want to have the wind at your back. So i.e., you want to have the market at your back. And so the reason why that was the time to short it was because the cues were, they were hitting against the 200-day simple moving average. So again, moving average, when broken, tends to act as resistance. And so you have the market lining up for you. And then as the market flushed, NVIDIA flushed as well. And so that's how I kind of took that short. And then again, I kind of covered it on that left side low again. So quick trade.
Do you size any differently with the short sells, or it's kind of the same process for you, looking at where the stop loss will be, where your entry is, and what that distance is, and then how much you're willing to risk? Do you size any differently for short side trades?
Well, no, I don't size it any differently. So like you said, it's entirely dependent on how I can get how tight I can get my entry to my stop loss. And it's just by nature of how I time my short selling on a 5-minute chart is how I get my size on. So with long trades, it's slightly different because I don't time it. Well, I occasionally do, and it's something I've explored later in the year. But I try to, find a pivot, a priority high, and I enter with my stop at the low of the day. So the way that I kind of approach the short side is quite different from how I approach the long side.
Yeah. And this is kind of a larger question, but I think a lot of people request this on Twitter, and I know now to reduce volatility and reduce the drawdowns, you're risking less per trade. But you've mentioned in a few other trades you're risking 1% of your account. What was kind of typical for you throughout the year, and what kind of made you switch to a lower amount to risk of your portfolio now, and kind of going forward? What was kind of involved with that decision making?
Right. Yeah, that's a good question. So from the first quarter of 2025, I was actually still ranging between 0.5% to 1% of my equity capital per trade in terms of risk. And when I kind of did my post-analysis of Q1, I realized that I was very stressed out trading the first quarter. I mean, there were a multitude of factors that came to play, right? Like, first of all, it was my first year trading full-time. I was out of a job, so like my income was going to disappear. And then, Q1 was also a very volatile period. It wasn't conducive for longs at all. Short selling is actually very difficult. And so then, because it's so difficult, it's also highly stressful. And so then I realized that I didn't want to deal with that emotional volatility. It was a bit too stressful for me. And so then starting off going into Q2 and towards the end of the year, was when I lowered it to 0.3% to 0.5% of equity capital per trade. So I'd raise it as long as I feel like, the first or second position that I put on is showing me a profit, and then I'm beginning to gain traction in my trades is when I kind of raise it from 0.3 to 0.5%. And then, for certain kind of high conviction plays is when I would kind of risk 1%. And then, potentially even add on to the trade as it works. So yeah, like kind of how I eventually arrived at 0.3 to 0.5% was out of personal comfort. And then, of course, kind of hearing from other traders as well, right? Like, like you mentioned, like Mario's risk such a small amount, like 0.3%, and he can like propel his performance. And so then, not only does it kind of reduce the emotional volatility, it also kind of, the whole concept of building in failure, right? Like creating a system or a trading system that is unbreakable for the most part, barring any black swans.
Yep, exactly. No, thank you for diving into that. I think that's an important concept that a lot of people are focused on. They wanna memorize the setups and the entries and all that, and that's certainly important. But risk management, as anybody who's read the Market Wizards like you have, and anybody who's watched these interviews, that's really kind of the key thing that turns you from more of a boom and buster, unprofitable, to turning that corner and really seeing that progress. And it's something that every top trader is dead focused on. So I think that's I think that's really important to cover.
Yeah. Let's see. Okay, so long Baba. So this was a mistake actually. So like I mentioned earlier on, in February and March, like the Hong Kong and China equity markets had a good run. As the US stocks were breaking down, they actually showed relative strength and they continued to push higher. And so then for Baba, I missed the initial leg higher, and I was basically kind of having a lot of stock envy for missing this move, right? So I waited for the consolidation. It got tight, and then I bought it on an undercut and rally of the 10-day exponential moving average. So my stop will be on the low of day for that one. And then, 2 days later, it did break out, right? So it broke out of that range, but the day after, it opened on a gap down and kind of like closed lower. And so to me, that was it was a double top. And so I sold my position for a small win. But then actually the mistake came afterwards. Was the day after I sold it, it kind of put in a, I don't know if you consider it an inside bar or something, right? Like, and it was on
Kind
low
of
volume
vein,
too.
yeah.
Yeah, so I was thinking, hey, did I make a mistake selling it? And so I bought it back. And I don't know what went through my mind at that point in time. Like, I think it was just stupid, but I had thoughts that Baba was going to be the next liquid leader of the stock market when things turn. And so I bought back in size, like I doubled up on my position, kind of anticipating that breakout again. So again, mistake is like you try not to anticipate if it's not really a high quality setup. And then it gapped down on me, so I sold on that gap down. So this one set me back a little bit, even though I made progress in March. And so kind of looking back at this trade, it was such a low EV environment for longs that it was a mistake for me in thinking that this was going to be the next liquid leader. It was just ridiculous. So this was a bad trade actually. And it was one of the larger losers for the month in March.
Would you have liked to, you said you kind of missed the initial leg up. What would be, looking back and analyzing the prior move, where would you have wanted to get involved earlier? Obviously it reclaimed the 21 EMA around 81, but yeah, and there's kind of a 3-bar range there that it pops out of. Would you want to get involved there, or a little bit later on around 97 in that tight range that it forms there?
Yeah, that's a good question. And kind of looking back, I'm not entirely sure where I would get involved with BABA, because it just doesn't kind of follow what I'm trying to look for when I get into a stock. Like it did not pull back into the 10 and the 20 day, right, and begin to base. In fact, it was so strong that it just went sideways, and it probably found support at the 5 day and then moved higher. And so this is one of the struggles that I still face to this day. If we, we're going to talk about October later, and even, this month, to be frank, I'm struggling because I just can't seem to find any stocks that kind of base and consolidate near the 20-day exponential or the 10-day exponential, form a nice pivot and break out. Like a lot of the stocks, especially in this month, in the leading themes, have just ripped straight higher. And they're just too extended for me to buy, and I'm quite frustrated with that. So it's something I have to kind of work on and find more creative ways to get in, especially if the stock is showing so much strength. Is there an alternative way to get involved? That's a struggle that I still face to this day. Yeah. Okay, here comes the exciting part, Liberation Day. So to kind of end quarter one, right? So after March, I had made really good progress in terms of my performance. So at that point in time, I was up, I think, 30% for the year. And so, okay, going back to the principles, I had preserved my capital. I had achieved consistent profitability. So now I had the leeway to pursue superior returns. And I remember this very clearly again, Liberation Day at the time, because I was on a vacation to Macau, kind of celebrating Q1 with my wife and my kid. And it was over the weekend. And I was scrolling through X. And oh my God, like, I think everyone the past 2 months were so bruised up by that market environment and that whole market downturn that they're basically in fetal position, right? Like they've been hurt so badly, the whole X feed is like fearful. You could literally feel the fear emanating out of my phone, like out of your screen when you scroll through that feed. And then you have all these banks like saying it's going to be a 1929 style depression. But the Qs actually post-Liberation Day had already gapped down twice. And so kind of putting the whole thing together, sentiment, very washed out breath. I think there was a stat that Jeff kind of posted prior to that capitulation low day. Like, I think the percentage of stocks below the relevant moving average is almost like single digits. And, it's never been seen before. And so then the only play that I had going into that Monday was a mean reversion trade, because it seemed to me, and intuitively, just kind of, how watching markets trade, for the last 5-6 years, there's a good chance that we could bounce, was what I was thinking. And so then I got back from Macau on that Monday. I woke up at 8 a.m. Hong Kong time. And so then I was watching the futures trade, and I saw that gap down, and then I was waiting for a higher low. And so this was a really tricky trade because it's very hard to kind of define your risk if you want to buy an overnight order. And so kind of my mindset going to this one was, okay, I'm going to wait for the NASDAQ to form a higher low. And then what I'm going to do is I'm going to risk a percentage of my account into this trade. And then I would just run a hypothetical. If I'm down 10% on it, I'd lose, a certain portion of my equity capital. And so the play that I went with was the TQQQs and the SOXL. For the TQQQs, I bought it overnight on that Asia morning. And I was just basically I put 20% of my account in it. I was thinking to myself, okay, the worst case coming out of a cash position is this thing continues to go down 10% on me and I lose 2% of my account. So be it, right? I'm still up for the year. And then for SOXL I was just timing it intraday when the session opened. And I think it was news of Trump kind of walking back on his trade, on what he said in terms of tariffs that kind of caused that huge spike, that upside spike in the TQQ and the SOXL. And I was selling a third of that into strength. And then I eventually sold out of the entire position on the second day when it began to reverse. And that, in hindsight, was a mistake. So kind of going through my mistakes, post-Liberation Day, there were actually a lot of individual stocks that showed relative strength to the index. So there are a couple of ways that you could kind of see it. I would encourage all the viewers of this to kind of look back as well. So if you look at Palantir, if you look at Netflix, Robinhood, GV, these are a couple of examples. But, when the Qs were trading below all the moving averages, they were actually still trading above the 200-day or, the 150-day moving average. And on that Liberation Day, the final capitulation low, as they rallied, they actually rallied through a prior left side low. So again, kind of going back on short selling, shorts will be covering at that spot. People who likes to buy the setup, this price UNR setup, they would be buyers. And so they were all pulling off these price undercut and rally setups. And so then the bias that you should kind of have after that capitulation low is to be very aggressively long. So this comes down to experience and kind of market awareness, your situational awareness, to kind of understand that this is the time, if you want to be max long for minimal risk, to be long. But I had made a mistake here. So after selling out of my TQQ and SOXL, I was having a great month. It was one of the biggest months I had for 2025. But then after that second day, when I saw, the candle shift lower, I sold out of it and I shifted my bias to the short side. And I don't even know why. Kind of looking back at the charts, like Netflix, for example, as it continued to trade higher, I treated this as a double top. So post earnings, it kind of traded higher, and then it kind of rejected this left side peak here, which is actually a double bottom neckline. And then so I got roasted the next day when it follows through. And April was not good because I began chopping myself up, kind of leaning too biased short, beginning to think that, this could be a 1929 style depression and whatever. And that mean reversion was just temporary. And so I was chopping myself back down, and I gave back my progress for April. So I ended up the month flat, which is really disappointing. But it was a learning lesson. Kind of looking back, Netflix was clearly a long because it had began to show RS. Even during this entire market downdraft from February to March, it was showing relative strength. I should have been long this thing. And so eventually I did right my wrongs. In April going into May was when I bought Netflix on a green line breakout, and I put my stop below that green line breakout. So it's a Dr. Eric Wish concept. I recommend people, looking at his work. It's excellent. And so then kind of going from a flat month of April into May, was when I told myself, okay, I really need to focus. The bias is clearly long. I have to somehow get myself positioned in these stocks. And so this was May. Like you could see, we had emerged from the capitulation lows back into an uptrend. A lot of the leaders had shown themselves. They staged their price undercut and rally setups. And then even as they continued to trade into late April, into May, they were base building. And so Palantir was one of the longs that I got involved in. This was one of the biggest winners for me, for May. And it was a little frustrating trying to get long Palantir because I initially got long on the double bottom breakout neckline, and then somehow I got stopped, and I don't know why. I was just scared out of my position or something. It shook me out or something, and then I tried to get in again. So this was a very, very unconventional way to get in. But Palantir was also one of the stocks that I was shorting throughout the market decline of February to March. And the feel that I got when I was shorting that stock was it was very, very difficult to short. And kind of looking back, it made sense because it was one of the leaders and it had resisted the decline so much. And so when I shifted my bias long, I was staring at this Palantir stock pre-market. And so first of all, it was trading the pre-market. It broke out of the downtrend line, and then it wedge popped the 10 and 20 exponential moving average, and it began to check back. So, Oliver Kell, price cycle concepts. And so then on this break, I was buying at pre-market. The other thing you want to notice is it was trading at $100 psychological level. So the thesis here was, okay, I'm going to buy out of this pivot pre-market, and I'm going to set my stop just below $100. So it was a super tight, super tight stop. And then I was risking like 1% of my capital for this trade because I realized my mistake. I had to flip long and get positioned somehow. And then as the session opened, if you go back to this day, you would have seen volume pour into Palantir. And so then I added to my position at the open through a 5-minute opening range high. And then as it continued to trade higher, it began to flag. So this is a 30-minute chart, but if you look at the 5-minute chart, it was an intraday VCP. And so I added on the break of the VCP, and Palantir was a huge position for me. And I rode it higher. And so as I rode it higher, because it was such a big position, I began to scale into strength. And then, mind you, as it traded into the prior left side peak was when there was earnings coming up. So I didn't want to gamble into earnings again, so I sold out of it. But of course, there was a second play on that earnings. So kind of drifting higher into earnings, expectations for Palantir was high. Obviously, if you talk about a fundamental standpoint, it's quite overpriced from a fundamental basis. And so I was thinking, okay, it would be an earnings gap down. And so eventually it did gap down. And basically what I saw at that point in time, beginning May, was that earnings gap down was also being supported. So if you look back at the chart of Spotify, it gapped down on earnings and then it found support. So I was using that as a precedent for, okay, Palantir gapped down on earnings. Perhaps it could find support as well. And then continue higher. And so kind of that's what I did. I watched the earnings gap down. And then, so, we talked about short selling, right? How I time it intraday. In my mind in May, I was thinking, how about I flip it? Why don't I do it long? And so for Palantir, that's what I did. When it gapped down, I was timing this intraday. So it flushed, right? And then around this part of the chart is when it sells off into the 20 EMA. And then it begins to form a higher low and reclaims the 20 EMA, and then it moved higher. So like I was entering this on the basis of a MACD cross, the undercut and rally of the 20 exponential, and then I was just letting it trade with my stop at the low of day. And I was willing to take that added risk because I had profit cushion built up from my initial long in Palantir.
Just
Um,
jumping with the question. So for this initial buy, you didn't actually have too much profit cushion going into the end of the day. Do you have any rule about, needing a certain amount of profit cushion to hold it to the next day? Or like you said, you were just accepting that loss if it stopped out the next day, if it gapped down the next day, you just kind of take that and leave it. What's kind of your thought process around that?
right. I think the first thing I would think about is how much cushion I built up for the year. And so that kind of dictates how aggressive I'm allowed to be. And then the second thing is the market environment. So when reading the market environment in May was when I felt like it's okay to take the added risk and be aggressive just because of how flushed out we were from the April lows and how positioning was not crowded at all. Like people were really flushed out from April. And so then in that scenario, when I had built a cushion for the year and the market environment was favorable, if you look at the multitude of stocks during this time period, a lot of the intraday dips were being bought. Price action was very, very constructive, or at least to my eye, it was very, very constructive. And so I was willing to let it take me out if it stops me out, at the lows. But then the reward will be massive if it works in my favor.
Right.
Yeah. Robinhood was another one. So this was a pretty textbook kind of a double bottom entry. And so then I was buying this through the neckline with my stop at the low of the day. And then I was just scaling this into strength because of how fast it moved. And kind of looking back, this was a mistake. And it's probably in part of inexperience for myself. Whereas, whereby I recognized that it was a Liberation Day low. Everything was flushed out. We were going to reverse into a new uptrend. Any leaders that I bought coming out of that correction, I should have treated it as a longer-term positional trade. So not selling out too fast and kind of adhering to the moving averages should have been the way to go. And so then, although this was a very good trade, and I eventually sold it against the left side peak, it was a huge mistake because when you look at the chart of Robinhood, it went much, much higher. Similarly with Palantir and all the other leaders as well. So the learning lesson for me in May is obviously the best time to buy would be coming out of a correction and, stocks showing relative strength, leadership qualities. You want to kind of buy and then be patient with it and hold for as long as possible. And there are benefits to doing this. Number one, your capital is tied up. So it reduces your tendency to overtrade and make mistakes. And number two, you're in the best merchandise. So you're going to make great progress just holding on to them. And your worst case scenario is you exit the trade at break even or for a small profit. So that was kind of the mistake for me in May, I would say. Also kind of a funny story because in May I hit 100% year to date, and that was me hitting triple digits in record speed, right? So I P&L posted it on X. I was happy. I wanted to kind of remember that moment and put it and make it public. And then obviously I made all these trading mistakes, so it was kind of stupid. But yeah, that was May for me.
You're asking for the drawdown, for the chop.
Exactly, I asked for it, man. And so then in June it was not a very good month because I kind of drew down a little bit, and I was a little frustrated. So June was a very choppy period. When I look back, it kind of made sense why it was a choppy period, because the index was continuously 4 ATR multiples extended away from the 50-day moving average, and obviously May was a very good momentum run. So in terms of proliferation of stock setups, there weren't that many, even though there were some that appeared and they moved very well. So to me, June, the top ops were in Coin and CRCL, and both of them I missed. And it was very frustrating because I was watching Coin on that day before the breaking news, and I saw it rip, and I was thinking to myself, should I buy it? Should I not? And then eventually I didn't buy it. And it basically compounded into frustration because a lot of my peers actually got involved and they bought it and they had a good run and I didn't. So it was a huge stock envy moment. I began to chop myself up and I began to overtrade, and that's how I ended the month negative. But the good thing was I kept my drawdown small. So I had the opportunity to play again the next month. So, so one of the winners that I had for June was actually silver. So silver, I actually managed to catch this trade very early, but I made a mistake in selling it too early. It was building a 31-week base. If you kind of scroll back to the left side of this chart, and again, like this is kind of how I trade, right? So it wedge pops above the 10 and the 20 day, and it begins to check back and base, and I buy it out of a low cheat. So, you could kind of buy it on weakness as well, or you buy it out of this low cheat and you put your stop at the low of the day. And this made good progress for me to start June. But then towards the end of June, as I began to frustrate myself and missing all these plays and getting myself chopped up, I sold this out of frustration because I was trying to cushion the losses that I was taking, which is a mistake because had I held on to this and followed my rules, it would have provided more cushion to kind of reduce that drawdown. And if you look at silver, eventually it made a huge, huge move, and of course multiple opportunities to get on board again. So it's a question that I have for myself, like when, and it's something that I need to work on is, to what extent and like do I trail the 20-day and the 50-day? Is it determined by the size of the base? Because if I held silver on the 50-day, I'd benefit such a large move from it that it would probably be the biggest winner for me that year. Oh, well, in 2025. Yeah. And then a mistake in gold. So I did trade in and out of this base, but then, it just did not show RS the entire way, so it should have been avoided. And the correct time to play this was eventually in September when, the markets went on a momentum run. And so kind of going back to my frustration, like I took a whole series of losses, chopping myself long, short, trying to make progress, but I couldn't make progress. But I was kind of sizing down when I began to hit my losing streak. And so that's how I kept my month really controlled. And yeah, some Jeff Sun quotes to kind of remind yourself, and I look at them to remind myself as well, is to always be patient and avoid playing if, there's no fat pitch. Yeah. So going into July, markets continue to lock traders out. It continued to be extended. There were some setups though, right? So I kind of went through this in Leif's interview as well, Futu. So the Chinese equity markets, Hong Kong equity markets were setting up. And then I bought Futu coming out of this big base. The stock was in RS phase. It's been persistently showing RS. And then it found support, and then I just bought it off. I believe it was an opening range high entry tactic. I think it was the 30 minutes, and then stop at low of day. And then eventually it followed through, and this one I was decently happy with because I sold according to my rules. So 2 ADRs, unrealized profit from my entry. When it began to trade 8 to 10 ATR multiples. And then I eventually sold it all because, again, I was facing trading fiction. I was stopping out again. The market environment began to get very hostile. And so then I was selling out of it, kind of stem my losses, which again is a mistake. In terms of a short, I remember that July was not good for the software sector, and CrowdStrike was one of those, right? So here's an example of a late stage failed base. So CrowdStrike broke the 20-day exponential moving average, found support at the 50-day, and then begins to kind of wedge higher somewhat, and then gets rejected into the 20-day exponential. And then so I was just buying, I was shorting this and then covering at the lows. And so this was well, a decent trade. I wouldn't say it moved the needle too much, but this is an example of a late stage failed base.
And for these shorts, just as another example, you're shorting kind of against the level as it starts to move lower, like against the 21 EMA here. You're not waiting for it to break the prior day's low. Is that right?
Yes.
You're looking
yes,
for...
that's right.
Yeah.
Well, so what I would like to see is like it trades up, and ideally it uppercuts the 20 exponential, and it begins to trade lower and rejects it. And so then you have a level to risk off of, which is the high of the day. And then you size according to where your entry is.
Yeah. And one thing that stands out for me is like the bar that broke the 21 EMA on crowd. Like when you see that type of bar, like I'm expecting consolidation correction of something like that. It just broke so many lows at once. It was a much bigger size than typical. And then, yeah, it makes sense to look for that lower high, which basically forms against the moving average. Yeah, I need to go back and study some short trade ops, because that's something that I want to improve on into the future. So yeah, here's a intraday. Perfect.
Yep. So this is the intraday. So you notice that it kind of trades up in uppercuts, and it begins to reject the 620 period MACD, begins to cross and goes negative. And then you see the selling volume come in. And then, so that's when I kind of shorted it as it began to break the intraday view up as well. And then I was holding it until, where I covered.
Yeah, nice trade.
Yeah. And then this one, Ethereum. So I went through this in Leif's interview as well. This was the biggest trade for me for the year. So I made a lot of money with this one. And there were a confluence of factors that came into play here. So, when you kind of evaluate the quality of the setup, you want to have the weight of the evidence stacked in your favor. And so that increases the odds of it, being successful. So a lot of the, beginner mistakes that, beginning traders make is they just look at it purely as a setup, but they're not stacking all these different factors into play. So kind of what I saw with Ethereum was it had begun to perk up and show relative strength, right? So that's the first thing. And it's beginning to outperform the market. Technically, in terms of a setup, again, it reclaims the 1020, checks back and begins to base. And, so you could call this a Oliver Kell base and break or a Mark Minervini low cheat. In terms of group strength, Bitcoin was similarly forming, that kind of setup too. So you have the relative strength to the market, you have the group strength. In addition, if we look at the commitment of traders report back then, I think it showed large speculators max short. So that's another factor that comes into play is when if Ethereum does continue to go higher, then it could potentially cause a short squeeze, right?
Yep.
And then finally, with regards to the technical pattern, you could see that as it begins to base before the break, volume was drying up. So it kind of signifies that supply was not coming to the market, right? So there's not a lot of speculators trying to short this. And so it worked. This was a very high conviction play for me. And so I risked a % of my account on this. And then as it broke out, I added to it as well. And so that it became a pretty sizable position, I believe. And then I was following my rules again. I was selling a partial at 2 ADR for my entry, and then 8 to 10 ATRs from the 50-day. And then eventually, as it closed below the 10 and 20-day, I was out of the position. And so initially I thought, okay, end of the move. It was a great trade. What a banger. I'm on track. I've, hit triple digits. I'm done for the year. But no, we're not done yet, right? So then it sets up for round 2. So it breaks the 20-day, and it was a shakeout because it reclaimed, puts in an inside day on a below average volume, another inside day on below average volume. And then so I was kind of anticipating that, okay, the move is not over. We could be going on another run. And kind of with Ethereum, I was timing this entry on the overnight session during Asia hours. So I was watching it trade into the moving averages, and I was buying it on strength risking the low of the previous day as it turns up. So that was how I was able to get my size for Ethereum on this second play. And so then it's kind of like reversing the concept of short selling, right? So you kind of watch it uppercut the moving averages and then reject and fail lower. So this is just the opposite. And that's kind of how I time this pullback buy in Ethereum. And then I was kind of following my rules, selling partials, and then eventually close it on a break of the 20-day again. And then, so this was going into August again. And it set up again. So this was closer to, the third round was closer to, it was Jerome Powell's, I forgot what it was. It was some event. Basically I was buying, so different confluences here. So first of all, it was the uptrend line that could support price, an undercut and rally of the 20-day exponential moving average, which was how I timed my entry again, risking the low of day. And then it was this event day where I sold, I think 25% of my position, and it eventually closed the entire thing and round trip a huge chunk of it when it began to violate the 20-day exponential on volume. So you notice, like, during this entire run up in Ethereum, so these light blue accumulation bars to the left, these are 10-day pocket pivot volume signatures. So it's a concept that you can read in Trade with the New Disciples by Gil Morales and Chris Catcher. So you kind of want to see these volume signatures to have conviction that the trade is, has legs and is going to continue. But, as we progress later and later on into the trade, you'll notice that the accumulation bars began to turn to distribution bars. So that can kind of inform you that we're getting later and later into the move. So just a nuance that I thought I could point out.
Yeah, and to point out, 2 days to the right of the last pocket pivot, you have pretty high above average volume with a very tight day that faded from highs, and then it followed through on high volume the next day as well. So there was kind of churning action happening right up there. I want to break down this trade further because I think this is a fun one to go over. Do you mind going one slide back for me? Actually, one more slide. Sorry.
All right.
So for the second trade, did you close out your full position as it broke below the 10 and 20, and then you kind of put on a whole new trade, or did you still have some position on as you went for round two?
So I closed out the entire position, so kind of just sticking to my rules, and then I put on a new position going into round two.
How was the position sizing different, or how much did you risk the second time around versus the first one, which you oversized and really went for it on that first round?
Yeah. So this one was kind of standard sizing. I was going for 0.5% of my equity capital per trade for round two. But then I was able to get a decent size of it just because of how I timed the trade. So like watching the overnight, so it's my daytime here in Ethereum, and then utilizing an overnight order. And then how I kind of set my stop loss is I look at the low of day for that close in, so ETHU, the 2 times lever, was my weapon of choice. I was using that low of day close as my stop. So it would be the prior low of day for this chart. And, as it kind of traded into the 20-day exponential and turned higher was when I got my entry. So I was looking at the overnight quote, the price at that time, and calculating my position size based on my predetermined stop loss for that prior low day.
Yeah, and that was actually a question I wanted to bring up because some people asked about it on Twitter. Obviously, you're in Hong Kong time, trading a lot of the U.S. markets as well. It could be an advantage, it could be a disadvantage, certainly in some respects. What kind of adjustments have you made to be able to trade the U.S. markets effectively? And I guess how do you feel like that impacts you as a trader? Like I said, there could be pros and cons. You're not watching some price action, but you're limited to what you can watch as well. So yeah, how have you kind of dealt with the time difference?
Yeah, that's a good question. Personally speaking, I kind of prefer trading in this time zone, versus if I was trading in your time zone. And the reason is because I can kind of structure my day in a sense that I could get, anything X trading related out of the way during the day. So like I get my workout in, I could get a nap in, I kind of send my son to school and spend time with the family and all that. And also kind of, build my model books, the reading and my research during the time when the market is not open, my preparation. So I do prepare, I flip through my watch list and kind of determine what are the stocks I want to focus on into the trading day, which for me would be either 9:30 or 10:30 at night, depending on daylight savings. And then for me, the session, so right now it starts at 10:30 and I have like a predetermined focus list of stocks that I want to, focus on for the session. And then I kind of watch things trade. If a stock triggers my entry, I'd buy it during the session, and I'd be watching, for the most part until 1 a.m. And so then I'm just kind of observing the first half of the session and getting my executions in then. And just kind of knowing that because I live in this time zone, I have to forego the other half of the session, because if I stay up all night, it's not sustainable for me. I need my 7 hours of sleep.
Yep.
And I find that routine helps me somewhat in terms of not overtrading when I'm already overtrading. I'm a chronic overtrader, right? So, and also kind of staying very focused and just controlling what I can control, which is doing the work beforehand and then identifying the stocks I want to focus on and just doing my best to execute well. So yeah, I find that this time zone works for me. That's kind of how I work around it.
Yeah, and you've said a couple things there that could fall under this, but any advice for traders kind of similar to you that, are trading Hong Kong time or just a different time zone than the US? Any kind of general tips that you'd give them to, things that you found helpful?
Definitely prioritize your sleep, because you need your mental focus, especially when the trading session starts at night. So kind of rewinding back a little bit in 2024, when I joined the competition and I was also working a corporate job, man, that was hell. Like
Yeah.
I hated my life back then, because I was waking up at 7 a.m. in the morning, kind of sleep deprived, 5-6 hours of sleep a night. And then I had very limited time to prepare, right? So I had to find those pockets of time in between during the day to prepare for the session at night. And so like during the day, I was dealing with stuff in my corporate job, which kind of took up a lot of mental capital. And then I was using lunchtime to kind of scroll through charts and prepare my daily plan. I was using my commute time. I was looking at charts on my phone to kind of determine which stocks that I wanted to focus on. And so my advice to, I guess, people in this time zone, especially if you're working, is time management is definitely very important. Do prioritize your sleep, and how you can prioritize your sleep is just focus on one setup, right? So in 2024 for that competition, I was really just focused on one setup, which is to trade a volatility contraction pattern or a low cheat. And that's it. And all you need to do is to be in a right market environment where things work, and you could easily outperform the market. It just takes one market environment, like one good uptrend, to make your year. As long as you're focused, you take care of yourself during the day. And yeah, prioritize your health, because the moment you can, you're healthy, you can be focused, and of course, manage your time well, is what I would say with Hong Kong or Asia traders.
Yeah, I think that's sound. And like my personal time difference, so I'm on the west coast of the US, so I have to wake up pretty early, so it's kind of the inverse of you almost, but I have to do a lot of my work the day before, because I don't want to wake up, have to wake up so early. It's all about just kind of getting oriented. I've done the work before, I'm prepared, all of that. But I do prefer the East Coast time. Like I preferred having that time in the morning to get ready, but it's something you kind of have to deal with if you've got a time difference.
Yeah,
but yeah,
that's right.
thanks for those thoughts.
No worries. So kind of going through it, we have a little bit more left. August, I think August was a period where a lot of traders struggled, just because it was very choppy, right? So, okay. So one thing that I kind of want to mention is, a lot of traders would ask me, how do you determine the market environment? And how I do it is I look at the balance of setups. And what I mean by that is, for me, I maintain a watch list. So kind of like you, right? In terms of my weekend routine, I would run through screeners and I would put, whatever stocks that look strong or interesting into a general watch list. And then throughout the weekday is when I would flip through all these watch lists every day. And then I kind of recategorize each stock, depending on whether I think it's almost ready and needs a little bit more sideways, or it's ready and could trigger during the session, and just stuff that's, okay, it's extended, I can't chase it, but I will watch it in case it sets up again. And then I also have another watch list of, in case those stocks also begin to break down, I'd put it in the breakdown list. And so then I begin to look at the balance of setups. Are there more long setups? Or are there more short setups? Or do I see a mix of both? So going into August, I actually saw a mix of both. And given the extension in the indices, I was kind of prepping myself towards the end of July, especially when I was, encountering a little bit of friction in my trading. I began to stop out a little bit more. That we're gonna be in for a chop environment. So then I shifted my mindset again from, being a little bit more nimble, and that's kind of how I approached. August. So, for example, given how extended everything was, Roblox was a pretty opportunistic kind of short sale. You see, like, from April all the way into August, it had gone up massively, right, on a big run. And at certain points of the stock move, it was actually more than 10 ATR multiples extended away from the 50-day. And then the other thing was, I kind of noticed that earnings gap ups were being sold into. And so when Roblox gapped up, I took it as an opportunistic short with my target to cover back at the previous base breakout level. So it was a quick scalp. So you could see the entry here. It gapped up, post earnings, right? And then when the session opened, it immediately sold down on volume. The 620 period MACD began to cross, and then so I was kind of selling short the first 5-minute bar with my stop at the high day, and then kind of got my fill down here. It broke below intraday VWAP, and it just stayed heavy the entire day. And then the next day, it kind of gapped down and traded into the base, that previous base breakout level, if you want to call it that, and I was just covering it. So it was all these kind of opportunistic trades that I was taking. The other trade that I took was SQQQ. So, and I took this pre-market, and the reason why I did that is because coming into August, the indices was very, very extended. So kind of rewinding a little bit, this was the beginning of August. So you saw that things going into August was slightly euphoric. I think a lot of people were kind of excited, and the indices was like opening on a gap up. And if you plot like a Bollinger Band to it, it was trading right at the upper 2 standard deviation of the Bollinger Band. And kind of thinking about the balance of setups that I saw, it became an opportunistic short that I could take. And so this was kind of how I timed my entry. In the pre-market, the 6 and 20 period MACD began to cross and go to the upside. And so I was just buying this in anticipation that this was going to go higher just because of how extended the Qs were. And then I was setting my stop below at some arbitrary, like it was 10-cent stop. And then at the open, it worked immediately. And then I held on to this and began scaling into strength here. So my first scale was actually at a prior undercut and rally level in, I believe it was undercut and rally level. Let me check. Yeah, it was at a prior undercut and rally level where it traded in below the 20-day exponential moving average, but it also coincided with a prior left side low. And then, so I was taking my first scale, and then as it began to trade higher was when I got out of this trade. So a lot of my trading in August has been very, very opportunistic. So ServiceNow is another example where, back in July, the software sector began to break down. And the whole narrative was that AI is going to kind of make all these software companies redundant. And so this is also another very typical late stage failed base where it traded below all these moving averages. And then it gapped up on earnings. It got sold down. So that's a key tell. Like you see something sell down on earnings. And so you would start to think like there are sellers right there. And then it begins to wedge into the 50-day this time. And then it sold off. So I was selling short this, covering at a prior left side low. And then eventually it did go much lower. So I had to think about how I can hold a core in these shorts.
Did you consider selling short on the earnings gap up day against that base pivot level, or this was something you saw a few days later?
Yeah, I saw this a few days later. And so like looking back, like that earnings gap up day was perfect for a short. It was the best level. But I didn't manage to catch it. It wasn't on my radar at that time until after the fact. And so then I was watching it set up again for another opportunity.
Nice. You're training my mind to look for shorts. So this is perfect. This is great.
Yeah. And so August was a very good month for me because of how I kind of been able to trade opportunistically whilst also holding a few key longs, right? So Ethereum I was still holding and trading in and out of on August. And then PopMart was another one that I kind of went through in Leif's interview. So I'm not going to go through it again. But like it was through being able to chip up and build cushion for August was when that Jerome Powell event, I forgot what it was called. I had built a big enough cushion where I risked pretty big going into that event. So prior to that event, I think month to date I was up about 20%. And whilst the market was choppy and it looked like it was going to break down, there were certain sectors and stocks that actually resisted the decline and looked like they were setting up. So I also kind of distinctly remember going into that event. Oh, it was Jackson Hole. That's right. That my X feed was pretty bearish. Everyone is kind of expecting that post-event things were going to sell off, which eventually it did. It faded. But that first move higher was what I was able to take advantage of, even though I gave back a huge chunk of it. Was once I built the cushion, I parlayed a lot of that risk into buying Ethereum, BMNR, and all the Ethereum-related plays. So for round 3, I actually risked, I think, like more than 1% of my capital in that trade, and I trimmed it. And so that was how post Jackson Hole was when I had a 1 day 20% gain to my account, which I kind of gave back. But the point I wanted to bring across here was coming back to Victor Sperandio is to always kind of prioritize your trading business in the following order. So always remember preservation of capital comes first, and then comes consistent profitability, hitting those little wins to build progress until you see a very high conviction play is when you have the leeway, especially you have the cushion built to pursue superior returns. And so that's, to me, how you can build an equity curve that constantly forms higher lows, keeping the drawdown small, and kind of turn yourself from the boom and buster to, I guess, a more consistently profitable trader. So that's kind of the point I wanted to bring across with this slide. And then September was one of those momentum periods again, similar to May and similar to late April to May, where the moment the index kind of did an undercut and then of this prior left side low, it was a UNR spot. It also coincided with the 50-day simple moving average. It started to go on a run. And this to me was one of the 2 easy dollar environments this year. And so this is a bit blurry, but one of the biggest winners for the year as well for me was in taking this EP in Octo, which is now ORBS. And the news here was that, this year we kind of saw a lot of the digital, like companies announced their cryptocurrency reserve plans, right? And all of them went out like crazy. So you have your ASST, your DFDV, BMNR. And so going into September, to me, this was what kind of sparked the whole momentum risk-taking in September. I saw this piece of news where they were announcing a strategic reserve for WorldCoin. But the key detail that I read was that AIDCO appointed Dan Ives to the board. And when I saw that, it immediately reminded me of when BMNR announced their strategic cryptocurrency reserve plan, and they announced Tom Lee to join the board. And so to me, this was like a 5-star EP, even though I don't take it very often. And I had so much conviction in this that I market ordered it using an OPG order. So it was an opening price gap order, which means you get priority when you market order it. And I just put 10% of my account in it. And it just proceeded to go up over 100%. So I sold this into strength the next day. And kind of going back to your point on how do you decide when to hold and when to fold, is AIDCO was obviously a shitco. It's a shit company. So these kind of plays, you kind of want to sell into strength a bit more. But, this was a very, very big win for me to start September.
So that was about 10 to 15% equity contribution then, if you had 10% to start with, right? Yeah, that's a great trade.
Yeah. The other great trade, which I'll go through again here, is gold. So remember, like previously, gold was building a big base, and I was trading in and out of it, but I shouldn't have because it did not show any relative strength, right? So in September was when the stars aligned, right? So it began to build this huge base. If you look at the weekly chart, it's a very, very nice VCP. It began to form higher lows in terms of the price structure. And then it wedge popped, put in inside day, and I was buying, the low cheat. And then I added on the official kind of breakout level. So this went on a very, very big run. And then again, it's a reoccurring mistake that I have is I keep selling it all prematurely. And it was because towards the end of September was when I began to encounter a kind of friction in my trading, so I was getting stopped out, which I'll go through a couple of losses in a bit. And then I was just selling out of this, even though it did nothing wrong. Because the thing that I should have done, given the size of this base, is to hold my position in full and wait for a violation of a moving average. And so kind of regret selling it, but, a lesson for next time. But in terms of the friction that I was talking about, Oracle was a trade that I took. So post earnings, it gapped up it gapped up huge for a stock of this size, and I took it via a 1 minute opening range high. I immediately got stopped. However, because I was up for the month in September, the beginning to the middle of September. And it seemed like an easy dollar environment. And, there were multiple thematics that were firing off. There were a lot of stock setups. I was being a little bit more risk-taking, kind of buying Oracle. So I anticipated a buy here. So like my first buy failed, and I was risking 0.5% of my equity. And then as it traded sideways and the 10-day exponential moving average caught up, I was anticipating a buy here, so I just bought it with my stop at the low of day. And then it worked. Like it uppercut the previous gap lows, and I was thinking, yay, beautiful, right? And I sized up adding into this, but then it pulled back. And it found support at the 10-day exponential, and I was thinking, okay, maybe it needs more time sideways. I can afford to be a bit more patient with it. My stop is close by, but not yet. And then I got hit by a gap down. And so then this kind of set me back again. I began to incur a series of losing trades going into the end of September. So, lesson learned. I was way too aggressive with this one. Um, yeah, not a good trade. That, to be honest, there was no trade at all, so I shouldn't have even taken this. Okay, so coming into October was when things got really frothy. So, if you recall, in the beginning of October, there were a lot of stocks going crazy, especially the minerals. So the strategic minerals, the metals, and like even the OpenAI play. So I remember AMD kind of gapped up 50% in a day, and I was kind of missing all these plays, right? I was kind of feeling that, given how extended we are and how crazy the run was, I began to shift my bias short, and I was kind of shorting stocks as the market continued to trend higher. Especially like plays like Palantir and NVIDIA when they were chopping sideways, and I was basically kind of chopping myself up. There were a couple of days where it worked. So October 10 was the character change bar, when it was a Liberation Day 2.0, when Trump kind of threw a tantrum or something, and I had a good day here being short, but I did not cover. If you look at the futures on this day, it actually touched the 50-day, and that should have been a cover point. And so then I held with a bias that we could go much lower, and obviously we didn't, and we basically chop, and ended up higher. So I kind of made zero progress this month, and then kind of seeing the plays that I missed. So USAR, USAR, I had this at the beginning of the month in my watch list, and I saw it break out and I didn't act on it. But like, this was such a good setup because it built a huge base, and then it VCP'd, and then it just went. And I should have taken this trade through this prior day highs with my stop at the lower day, and it quickly doubled. And so then, kind of missing all these plays in October, I was very, very frustrated with myself. And then I was also watching stocks go straight up, and I couldn't get in. There was no entry for me, and I was even more frustrated. So I made no progress for the month of November. The month of October. Yeah, so that really, really, really sucked. Especially seeing everyone making huge progress. There were people messaging me like, "Oh, Clement, this is amazing. I'm up 15% for the month. I'm up 20% a month." And I'm like, "Congratulations, man." And then in my mind, I was like, "Oh, I suck so much as a trader that month. I was not making progress." And so the frustration builds, but I'm just kind of like trying to control my drawdown and keeping it small. Just kind of waiting for my pitch to play again. So that was October for me. I had nothing notable. I did everything wrong. I couldn't make any progress. Yeah, it was a frustrating period.
Could you actually bring up that USAR chart again? Because just want to kind of touch on a higher concept. VCPs are obviously a setup you love to trade. I know you didn't take this one, but could you break down kind of what you look for on the right side of a VCP? What are the price and volume characteristics that tell you, okay, this is a stock that could be explosive and it looks ready for, to be actually actionable and for the entry? So what are you looking for on the right-hand side of a VCP that says, watch out for the breakout and be ready to act?
All right. Okay. That's a good question. So kind of breaking it down from a higher level first, if we look at the weekly chart, you could see that USAR has gone sideways, and it's built a pretty big base, right? So it's kind of had like this correction here, 70%, and then it went up and then corrected 56%. It went up and it corrected 30%. So every contraction as it goes higher, it gets tighter and tighter, right? So volatility in the price action is contracting. So here, this last weekly contraction was 32%. And then when you kind of look at it on the daily chart, so this was the last kind of, let me hide this. This was the last impulse move higher, right here. And then here, it corrected 30%, which was the weekly. And then from here is when I began to look at it from Oliver Kell's perspective, right? Look, so it wedge popped and begins to trade above the 10 and the 20-day. And then as it traded higher here, this is to me, was kind of like the final contraction-ish. So this was 14%. But this daily bar here, so if you look at the volume signature, you start to see 10-day pocket pivot volume signatures. And then what happened with price is it begins to go inside 1 day, inside 2 day, inside 3 days. And then when you look at the volume, it's relatively light. Okay, so not too much supply coming in. And then when you look at how it is performing relative to the market, here's your RS phase. It's persistently, trading above its own moving average and trending higher. And then, so then you could think about it two ways in terms of entries. The first entry you could think about is this kind of pin bar here, where you could kind of take this entry through the high of day, and then you could stop at the low of day here, right? So in terms of trade risk, it's about what 9%. But also kind of bear in mind that when we look at it historically, so it's a 8.7% ADR stock. So it's 9% trade risk. It's okay because it's kind of within it, but not ideal. And then, but with this bar, it's 7%, right? So, 7% trade risk for about 9%, kind of ADR stock, not too bad. And so then you could take it through this high of day here with your stop at the low day. And so the next trading session, it eventually did break out, right? And the other nuance to note was, other than USAR, the other mineral plays were doing very well. So MP, I forgot what the other ones was, but they were all, it was a group move. So that's another edge. And on that day, it just broke out, right? So it broke through the prior day high. The volume signature, look at this. So this was the highest volume ever in the entire history of this stock price, of this stock's life cycle. So that's kind of what you want to see. You want that volume on breakout. And then what happens after that is you get confirmation. Another one, highest volume ever. So volume kind of confirms the price move. And very quickly, this just doubles, right? So like if you're risking about 7% for this trade, you size up accordingly, according to that trade risk. Very quickly, in about 4 sessions, you're hitting 10 times ATR from the 50-day. It's 60%. So from a risk reward standpoint, you're making what, like 1 to 8, 1 to 9? That's a great trade, and it's an A+ setup. So kind of missing this A+ setup for me was look, and it continued to go even higher. So it was a bummer. I was frustrated I missed this.
Well, it's a good one to study.
It's a good one to study. Model book. Yeah. And then the last month that I wanted to go through, and then we'll talk about December, was November. So November was when we finally saw that correction, right? So I managed to capitalize on this. So right here in November, I was still quite stubborn with my short selling. So I did short the beginning of November. And the reason why I did it was if you plot an uptrend line in the Qs, price was actually trading above the uptrend line. It was massively extended. A lot of stocks kind of began to break down. So your former leading thematics, like if you talk about AI, high performance computing, your Iron, Cypher, Wolf, Oracle began to break down, NBIS began to break down. You start to see all these breakdowns in stocks that previously led the run up. So with the Q so extended was when I kind of timed my SQQ trade as it began to reverse higher. So again, same concept, 5-minute opening range high, 620 period MACD crosses higher. And the very important thing you want with these inverse leverage ETFs is they have to work immediately. Because if they kind of go up and start to chop, then it's probably not going to work. And so then I managed to catch this short, and I was like kind of selling partials along the way. And then the other short that I was able to take advantage of was NVIDIA. So, remember at the beginning of the year, NVIDIA reported earnings in February. Everyone got excited and they wanted to go long. No, you short that. And so this is the same concept. NVIDIA reported earnings, it was gapping into resistance. And so you don't want to long that. You want to short it because moving average tends to act as resistance. So I timed this SOXS trade as well. I was watching NVIDIA trade, and then SOXS began to go sideways. And then the 620 period finally crossed. It reclaimed intraday VWAP, volume came in, and I just got long. So this was a very quick 20%, I think, in 2 days, which I eventually sold out of. Yeah.
The linearity of that intraday chart is cool to see. It just went from your entry.
Yes. So for I've noticed kind of doing the review for 2025 is for inverse leverage ETFs. They absolutely, once you time the entry, it has to work immediately. You want to see it leave your entry as soon as possible, because if it gives you 1, 2 green candles and it starts to chop around, is when you know that there's a higher probability of this failing. So that's that for the inverse leverage ETFs in the way that I play it. And so after that day,
I've got one more question, Clement, if you don't mind.
Right.
Is there a reason you didn't take the right off the open, that 5-minute opening range breakout, as the MACD cross there as well? Is there a reason you kind of waited until it consolidated a bit, chopped around, and took the entry you did?
So there wasn't a particular reason. So for me, I was coming out of a cash position at that time. In November, so the other thing that I wanted to talk about was kind of burnout, right? So I was just so focused with the entirety of 2025 up to that point in trying to push for returns and being so focused that I found myself burning out, actually. I was really tired, being so focused all the time that I did take a couple of days break away from the markets, and rather than kind of actively trading and pursuing for returns, was when I began to build, my model books again, and then I began to review my year, which is what culminated into all these slides. I have it all in my OneNote. And so then coming out of a cash position, I felt rusty. I didn't want to kind of be so aggressive at the start. So I was watching this trade. If it was me still actively trading, I probably would have gone guns blazing and get stopped out, and I probably would have had to try again. So yeah, the thing about burnout is a lot of people kind of have this kind of a preconceived notion that it's possible to do triple digits every year and it's very easy. It isn't. It demands a lot of focus, and that's one thing I realized. And what that means is it spills over into your lifestyle as well. And so then the question, I guess, for viewers to kind of think about is, what is the lifestyle that you want to live? For me, when I was so focused trading and being so into the price action and having a very good feel for the charts and in the zone, is there are times, especially when I spend time with my family, where I don't feel like I was fully present. Even though I was physically present, I was thinking about the markets. I was checking quotes from time to time. And over time, that burnout does build, which was kind of what spurred my decision to not join the competition again in 2026 and to really make it a year where I just want to follow my process and see
not
how...
feel that added pressure.
Yeah. Not feel that added pressure. That's right. Yeah. So sorry, I digress, but...
it's important.
Yeah. Coming back from the cash position, I was being a little bit more cautious, but it seemed like the layup trade for me on that day. And so then I eventually took it, coming out of a cash position, and that provided some cushion. So that was that. And then, so that was on the 21st of November. And so if you recall what happened with the Qs on the 21st of November, was it flushed all the way down to a prior price low. So let me bring that up.
Mm-hmm.
And let me remove this. So this was the day. Again, you want market confirmation, right? which was the day. This was the day, the 20th of November. So this was the NVIDIA earnings. So it gapped into resistance. If you flip through a lot of charts, especially in the former kind of leaders of the previous cycle, you would see they were all similarly gapping into resistance, which is what added to the conviction of NVIDIA and SOXS. But as it traded lower and had this massive bear candle, it was trading at a prior left side low. So again, the concept of price undercut and rally is a potential short cover spot. Buyers may also buy at that spot if they like that setup. It's a Victor Sperandio 2B setup. So what I was looking at was the precious metal space, because when a price undercut and rally occurs, I want to find stuff that has resisted the decline, right, the best. So I'm just gonna move these charts a bit so you can see. So this was what I saw at that point of time, right? Oh, it's even further. This is quite Christian Kulamagi-esque in the sense that, so first of all, the metals had resisted the decline for the most part, and they began to find respect at the moving averages, form higher lows, and so then you just kind of imagine, right? Like if the index undercuts and rallies through that low, that kind of signifies market pressure lifting off, right? So, buyers will step in, there's buying pressure. So then what will lift off the most? It would be things that don't have too much overhead resistance, is technically much stronger than the index. And so that's what brought my attention to the precious metal space. And so then I timed my entries after covering those shorts into gold and into silver. And so that kind of made my month for November. I think I had a 24% month to end because silver went on this massive run. And I was timing it on the undercut and rally of the 20-day exponential moving average. So November, yeah. So this is the chart of the silver trade that I was looking at the time. So it was trading below the 20-day exponential moving average. It undercut and reclaimed a prior key level, and then it began to get tight on a 15-minute chart. And so if I look at it on the security that I was trading, which was the AGQ, it began to get tight, and I was risking 0.5% of my equity on a 1.64% risk. And then it works because as the index rallied through that price UNR, silver similarly rallied through the 20 EMA. So that's kind of how I saw that price action at that point in time. And that was my November. So that was basically the epitome of my performance for 2025. And then going into 2026. So very, very funny story. I was pretty long the metals, and I had begun to notice that, a lot of the metal miners were also setting up, right? So when I look at something like so let's put this back in. When I look at NEM, it was just similar kind of VCP type. And then you could also argue that this was a cup and handle, right? And then, so this is a gold miner. If you look at Barrick Gold, so all these are institutional quality, big miners. So, it kind of formed a consolidation, began to go on a run. Pan American Silver. So they were all kind of setting up, right? So this one broke out of its cup formation and then handled out. I got long this. It went higher. And so then I was having a pretty decent start to December. And I was pretty happy about it. The mistake that I made was going into, I believe it was the 12th of December on Friday. So I kind of, I flew into Singapore for a friend's wedding, and we had drinks on Friday. And I told myself, Thursday was such a great day because the miners ripped, the precious metals ripped, and I had an outlier day. I think it was up like 10% of my account that day. And then Friday came, I told myself, okay, I kind of sold some into strength. I've improved my worst case scenario. I was also long a couple of other stocks at a time. So Lemonade was one of them because this kind of resisted the decline pretty well. I was long Tesla. It was on this day on the pullback. I bought it, as it kind of found support at the 10, 20, and 50. I bought it through a 30-minute opening range high. I was long a couple of stocks. I was long GRAL. So this was from November as well. But then unfortunately it kind of stalled and eventually failed. And then going into the 12th of December, I was out for drinks with friends and I was like, yeah, I'm not going to trade. And then I had a couple of friends I talked to about trading quite often as well. My friend Chester, and I was like, yeah, we're not going to trade. Let's have just nice drinks, end the night, maybe go to a club. And then the market opened. And I think it was because of Broadcom's earnings. And there was this whole AI valuation overspending fears that the whole entire AI complex sold off very aggressively. And my names got hit too. The miners got hit too. And I sold everything out of panic. And so looking back on that Saturday when I viewed the charts, I'm like, oh my God, Clement, you panicked and you sold out of everything. That's a huge mistake because they did nothing wrong on a closing basis. And so kind of going back into the trading week, I was trying to get back into all these metals. So I got back into gold, silver. I even had copper, platinum, palladium. I had the entire metals complex. But I had such a tiny size. I was only risking 1% of my equity across all those metals. So although I did benefit from the move that occurred later, I was nowhere near, my size to fully capitalize on the move. So although I made good progress, it sucked, psychologically kind of thinking, oh, I could have made much more, And so the lesson here is, guys, when you go drinking, you don't trade. You put your phone away, you delete your brokerage app, and just wait for the close and respect your stops. So again, kind of making the first mistake snowballed into even more trading mistakes. So Tesla, I got in here. Of course, I panic sold, and then I bought back on this gap up. And if you look at it, actually, there was no setup, right? So I had this bias and I was scrolling through Fintuit as well. This is a massive base. And, what happens when you have a massive base? If it breaks out, it's going to go on a big, big run because the bigger the base, the higher in space is the saying. And so then I began to fall in love with Tesla. And so I bought back after that panic sell. And as it moved higher, I continued to add. And the mistake here is I risked too much on that trade. And the second mistake is there was no setup to actually buy it on. And so I was quite happy on the 16th of December because it traded up. It looks like the volume was coming in. It seemed like it looks like it was going to fall through, and it failed. And the moment it failed, I was not nimble enough to get out because I had this preconceived bias that this is the character of Tesla. It's eventually going to somehow find support at the moving average and it will bounce. All will be fine. And then, of course, it did not because towards the end of December, it started to sell off. And I took a big hit from this. And Tesla wasn't the only one. Lemonade began to sell off too. And I had a couple other stocks that began to sell off in unison. And I was trying to get into new positions like SNVK. Like, oh my God, this is a picture perfect high tide flag, right? Like, you have this initial entry here. It moves up 500%, and then it corrects and finds support at the 50-day, less than 30%. It forms higher lows and gets tight. And I was just buying this prematurely, but getting stopped out. And all those mistakes kind of compounded into a 9% down month for December. And so then I kind of ended December really disappointed with myself because obviously I did not manage risk properly. I was letting my bias kind of take control, because what I saw was, I think stocks were like kind of chopping around, but there were some stocks that were still setting up and they looked okay, right? So WDC, for example, the whole memory complex was forming a base. So this is a base on base on base, and if you read How to Make Money in Stocks, it's a very powerful pattern. So I was letting all these mistakes compound, and it led to a big down month, which I'm quite disappointed with myself about. I didn't control, and I let it kind of blow through my 5% floor. And so then coming into January now is when I'm quite, how should I put it? First of all, I kind of lost confidence a little bit, right? And so that's not what you want to, that's not a state you want to be in if you want to trade well. And second of all, I've been quite trigger shy as well, kind of risking a very small amount, trying to find traction again and developing a better feel for the market. And of course, to start off January, we see all these crazy moves in these memory stocks and these uranium plays and drones, and I missed out on all of it. So pretty frustrated with myself right now, but then again, kind of thinking back through my entire journey, this isn't the worst I've been through. It's another roadblock. And, kind of looking at the grand scheme of things, my equity curve is sharply higher the last 3 years. So just being grateful that, this is a journey. Although like a lot of people say they're inspired by what I'm doing and how I've kind of turned things around. I'm also just still human and I make a lot of mistakes. And I hope that my transparency can kind of, help you guys realize that no one is a perfect trader. We all hit roadblocks from time to time. It's how you kind of bounce back from it and pick yourself up. That is the difference maker. Yeah. So that's all I have.
Still absolutely fantastic year, Clement, that you should be proud of. So, thank you so much for sharing. And I think the detail will help a lot of people out there who are probably going through very similar things. So I think this will help for sure. I just have a few more questions, some that were submitted by folks. First, could you talk a little bit more about the capping the monthly drawdown and your goal there? Because I think that's such an important concept that I think can help a lot of people who find themselves to be boom and busters as well. So what's kind of the goal there, and what did kind of Christian Flanders, what do you talk about with him that kind of and how much of an impact that can have on your trading?
Yeah, for sure. So kind of like that dinner with him was me kind of recapping kind of how I did for the year. I did pretty well to start 2024. And then I was kind of drawing myself down over trading. And then I kind of told him like how much I was risking per trade. And then the first thing he told me was like, when you begin to hit a losing streak, you cut size, right? So say if you're risking 5% of your equity capital per trade, you realize you've hit yourself a 2-3 trade losing streak. The next trade, if you're going to take it, is going to be 0.25% of equity capital. Doesn't work, so you cut size in half again, 0.125, until it becomes so negligible that it doesn't hit your equity curve at all. So like right. on an equity curve chart, it's just a small little squiggle, right? So even though it feels like you're trading horribly, which right now I feel like I'm trading horribly, it's not really moving, right? And and in addition to just cutting size per trade is kind of maintaining that floor, that 5% floor, not making sure your drawdowns don't exceed that amount. And the reason is mathematical, because think about it, like if you lose more than 10% of your account for that month, anything beyond that spirals and it works geometrically against you, right? So kind of going back to my huge drawdown back in early 2023, if I lost 50% of my capital, I need to make 100% to even break even, right? So as your losses snowball, it becomes harder and harder and harder to recover from, which is why, like, say if you hit your 5% for that particular month, next month be a bit more stringent. Have that as well to 2.5%, right? So trade really, really small until you feel like the environment has improved, you're catching your groove in terms of your own traction, And then you have the liberty to kind of try again. Maybe you wrap it back up to 0.5% and see how it goes. So that's kind of what we kind of spoke about and my takeaways from it. And then the other thing as well is, sorry, I kind of lost my train of thought, but yeah, so that's kind of, I lost my train of thought. It's probably not so important.
Yeah,
but did that,
the 5% drawdowns and like what you've done to try to control the boom and busting and keep that higher lows of the equity curve. So you covered a lot there that I think is really helpful. But was there anything else you want to elaborate on?
Oh yes, I remember now. So by capping your monthly drawdown small, you're giving yourself a chance to try again, and forgive yourself,
mental
and
reset.
try again.
Yeah.
And mental reset. Yeah, exactly. When the drawdown snowballs, it becomes harder to mental reset because, with humans, we are naturally loss averse, right? So the losers actually hit us psychologically much larger than our winners. And so if you keep the losers small, it becomes easier to kind of forgive yourself. And you just need you just need to string together a couple of nice winners to quickly go back to break even, right? From a -5 to a 0. So risk management and keeping your drawdown small is the key to really, make a difference and turn boom and busters into profitable traders.
One more aspect on that I wanted to ask you about is the use of margin, because people have questions about this as well. So obviously if you have a bad month, you want to cut size of your position, but will you also be less risky on a overall account level? So will you use less margin? And also just in general, how do you think about using margin? We've talked a lot about risk on an individual position level, defining that, but on an account level, how much margin are you willing to take on? And how do you think about overall, account level risk as well? That would be great to cover, I think.
Yeah. So I think the general principle behind that is, building upon Mark Minervini, he always says, build on the heels of success, right? So kind of how I think about margin is you really need to earn it. And how you earn it is by kind of easing yourself into the market. So say, for example, 100% cash position, you take a setup or two and you kind of gauge your feedback, right? So, okay, you see an unrealized profit, you look at the chart, it's followed through, it closed well, and then kind of go through your routine, you see more stock setups. Okay, I can probably start to risk a bit more, building on those unrealized profits for that next trade. And then you take it if it works, and then you keep going. And you keep going until, you see no more setups, right? And the market is getting extended, it's going on a run. Before you know it, you'd actually be on margin. So kind of earning your way into that is how I would think about it. Like I don't specifically think about, I don't specifically have rules as to, okay, I must achieve XYZ and then I earn the right to be in margin. It's more of kind of reading the market environment, letting the setups and your own traction kind of guide you to eventually be on margin.
Yeah, that makes perfect sense. And I think a takeaway for me from chatting with you, and I've kind of been thinking this as well, as you've talked a few times about, starting the year, and it goes back to the Victor Sperandio, quote, goal 1, don't lose too much, build a little bit of cushion, and then you can use that cushion to become more aggressive as you earn the right to, size larger and try to have a really good year. But you got to build that cushion first before you can get aggressive. So I think it goes back to that as well. One other thing I wanted to ask you is, you've talked a bit about kind of looking over your trades and key takeaways for that. Maybe just briefly, what's kind of your overall process for post-analysis? And what would you kind of recommend to traders who, maybe they've never done a post-analysis session before and this would be their first time? What would you kind of recommend that they do to start with to have the best return on their time as they start that process?
Yeah, that's a good question. So kind of sharing my trade review, which is basically very similar to, the slides that I've just shared.
Yeah.
Kind of how I approach my post-analysis is to first kind of, I write a couple liners on, the market context going into the year, or sorry, the market context for that particular month, right? And then I kind of look at it in the lens of what the indexes have been doing, and then reviewing my trades overlaid with the index. So like, and then the other thing is, on a month by month basis, I will look at, say, my top 3 winners and top 3 losers, and how I executed on them, right? So when I do that, I kind of realize, commonalities in terms of the mistakes I was making, in terms of what I've been able to do well. What are the commonalities in terms of the winners that I have? In terms of my entries, how do they actually look from an execution standpoint before they make a run? How do they look on the daily chart from a setup standpoint? And then once you do that, the other thing that I would do is kind of like, looking at the mistakes, your fumbles, right? Like, what are the things that you did not do well? What are some of your biggest losers, right? And then I would also overlay it, your buys and your sells. So your winners and your losers, overlay it on your index chart. And I think this is a very nice exercise to do, because you start to see commonalities in what makes a good setup. And so kind of my takeaway from this, and it also kind of confirms the findings by Jeff Sun, is when a stock on the long side is gearing up and ready to go, it first always shows relative strength to the index. It's always ideal if the setup is less than 4 times ATRs from the 50-day, right? And the index itself isn't extended as well. Those are the best times if you find a long setup to be long. So like kind of going through it month by month and journaling everything is how I would encourage people to do their post-trade analysis, because you really need to kind of dig deep and face your demons, your mistakes, and what you've done well, to kind of identify areas of change. And then the other thing I did was I kind of fed my trade history to an AI model. So I guess this is something you could do as well, and then ask it to kind of identify, where you've done well, where you've lost the most money on, what's the reason why you've lost the most money on, and then also kind of identify the commonalities of your biggest winners. And so then I kind of analyzed it, and I found that my biggest winners are very liquid stocks. They have very big bases, multi-week bases, and like they have they're not too extended from the 50-day moving average, so less than 4 ATR multiples. The Qs at the time was also not too extended. And so these are like all commonalities of the biggest winners I've had this year that I would want to focus on, and this would be like A+ in my book going into next year. And then kind of also doing the same for your losers, right? Like I realized that my biggest losers have always been bases that were too short, less than 4 weeks in duration, right? And they're also typically not very liquid, or shitcoins like Serve or Rich Tech Robotics, things like that. So, like then that gives you kind of a roadmap on what you can look to improve on going into the next year. And then you just kind of reiterate that process again, towards the end of every year. Like it does take a lot of time. So for me, this was kind of like a month and a half process, but it's the work that you kind of have to do to make improvements to your trading.
Did the AI kind of give you any analysis that you really didn't think about yourself beforehand, or did it just kind of confirm what you had already kind of gone through, looking at things manually?
Yeah, it kind of confirmed what I've been noticing manually, but I just didn't do like the back testing to kind of verify it until like AI spat it out. I'm like, oh yeah, this makes a lot of sense, and it's actually something that everyone's been talking about, but
right.
I just haven't really adopted it. So it's a good exercise to kind of like confirm your biases, and that in a sense also helps build conviction.
Yeah. Because the real value is in going through the individual trades yourself. Like you can't just skip to, you don't want to do the easy way, which is just give it your trades and
Exactly.
say, give me analysis, because you won't get the full value out of the process.
Exactly.
And I noticed on the left side of your chart, you're also doing a lot of research into top traders and historical cycles too. I think I saw 1897 to 1901 in there. So you're really going deep. Any kind of general advice for people who, want to study the art of trading and, past cycles, past market wizards? Cause that can be really helpful to, you learn from their mistakes, learn from their processes as well. Any thoughts here?
Yeah, for sure. I think with regards to individual traders, so one thing I kind of noticed, like reading all these books and, kind of watching interviews of the top traders on your channel, is everyone says something very similar, but in a different manner. So it's kind of like, find a trader that you want to study and then kind of find those commonalities, right? And those commonalities probably mean something because everyone is saying it. So for example, with Gil Morales, pocket pivot volume signatures, volume dry ups, undercut and rallies. These are concepts that, Victor Sperendio has kind of talked about in terms of, his 2B setup. And then, volume dry up also ties up very well with Mark Minervini's VCP. So you can start to study Mark Minervini, how he kind of looks at charts, where would he buy, where would he sell, what is he thinking? So I think on top of just the methodology that each of these top traders bring, it's also important to kind of pick up on their psychologically, like what are they thinking, and apply that to your own thinking. Easier said than done, but it's all these kind of stuff that when you study them, you can find things that kind of work for you, and implement it into your own trading. And so that's kind of how my journey has been has been in studying all these different traders and finding commonalities, things that kind of fit my personality and it works for me, and putting it into my own system. So it's a never-ending process. And so that's with the individual traders. And then with market history as well, it's kind of like, now with large language models, AI large language models, it's very easy to kind of go back and kind of read about market history. And I think there's value in that because history
Cycles
does not repeat. They always rhyme though. And so for example, if we look at, the 1930s, and there's a lot of resources, online. There are a couple of X accounts that do fantastic historical charts, and you just go there and take it and study it, and then run through the history of the stock, why it went up, through an AI model, and then you build all these examples. So this can be this is a form of a model book as well. And you'll see, for example, in the 1900s, the leading thematic was railroads, steel, and it's because it was very innovative at that point in time. Now, if we come to today, it's AI, it's all these data centers, space, uranium, there's an energy need, right? And so then it's a different theme, but the underlying driver is very similar, right? So kind of studying all these, model book stocks, and then also kind of studying, historical precedents. So a lot of people talk about this particular AI boom very reminiscent of the .com. So go and study the .com, look at charts of, how a stock bottoms after a correction. And so for example, the reason why I'm so honed in on undercut and rallies is look at Oracle, for example, back in the 1998, when the NASDAQ was double bottoming out of a correction or a bear market. Look at what Oracle is doing. It was forming a higher low. So these are the nuances that you pick up the more you kind of study and go through these cycles, and then you can kind of plot where would be the setup for you, where would you sell, and so this is kind of practicing and putting in the reps as well, right? And recognizing what a leader would look like, as they kind of set up and go for runs. So it's it takes a lot of time. It's a time-consuming exercise, but it's a very good exercise to to do to be able to spot winners and be have that experience to know what to expect after a market correction.
Yeah, to everybody watching, this is how you achieve triple-digit returns. Is this work right here? Studying past winning stocks, past cycles, top traders, and I mean, you can see the work that Clement has put into this. This is awesome. Yeah, fantastic.
Yeah, I have to say though, the 1990s were crazy. I don't think we're anywhere near that yet.
Yep. We'll see. All right. Well, perfect. Let me just, I think I've just got one or two more questions. Yeah, we talked about post-analysis. That was a big one I want to talk about. I guess I think I only have really one more question, and I guess this would be, Clement, for all the boom and bust traders out there, what would be kind of your key advice for, you've talked about a lot of things, the 5% monthly drawdown, progressive exposure, both to the downside and I assume to the upside as well, listening to that feedback. What are some other key things that can help boom and busters out there to smooth out their equity curves? And then also maybe, you've come back from a significant drawdown. Any advice for traders who are going through something similar, both from a tactical trading perspective, but also, as you've touched on, the really important psychology aspect as well of being able to come back from an event like that takes a toll for sure. So yeah, maybe starting with the boom and busters and then going to the drawdown advice.
All right. I think for boom and busters, the reason why we boom and bust is because we're greedy, right? We want all that upside. And we don't want it to ever end. And we want to make money as fast as possible. And so then, going into the 2024 competition, my mindset was, all right, let's see if I can stack up against all these top traders. I want to trade very aggressively. And I have these booms, right? And these booms came out of greed, right? And kind of being a little bit too narrow-sighted in a sense that the year is very, very long for a year of competition, right? So if you don't make a return now, it's okay. You'll eventually find your stride. It takes the whole 252 trading sessions in a year to string together a good return. So don't be in a rush, especially if you are not finding any traction or if you're trading very poorly. I think that mindset shift was what kind of helped me snowball 2025 into the return that it is. Kind of thinking, Oliver Kell likes to say this too, slow is smooth, smooth is fast. And his swing report is very good, by the way. So Oliver Kell, thank you if you're watching this, thank you. You've been a huge inspiration. Yeah, so kind of thinking longer term, although it's kind of ironic, right? Because trading is kind of shorter term, versus investing. But thinking longer term in terms of your equity curve, do you really need to push it right now if you're not doing well, or take your time and find your stride, because there will be so many opportunities in the market, in one whole calendar year. So it's like for example, you see it in my 2025 review is I missed all the biggest winners like BE, Iron, MP. I missed all of them, but I just needed a couple of good winners to put on a good year. So could it have been better? Yes. And so then that's room for improvement for next time. So kind of thinking long term for the boom and busters, and then being very aware of when you begin to draw down, cutting those losses and cutting size is very important. And then for those that are in a huge drawdown right now, I feel your pain. Kind of thinking back to that dark period of my life, I still do get emotional thinking about it. But then, don't give up. The light is always at the end of the tunnel. The sun always rises after the darkest day. And, that's provided though that you have to put it into work and have that determination to push through and better yourself. So kind of thinking about myself before that, that transition period after my large drawdown, I was very emotional. I wasn't process oriented. I was, like I was very, I guess, egotistical because I wanted the market to do what I thought it should do, trying to impose my will in the market. Whereas now, like after putting in, all this work and going through this, I've been more mellowed out. I'm more patient, even though I still overtrade sometimes. But yeah, like to those that are drawing down big, I feel your pain, but just know that it's not the end of the world. You can claw your way out of it, but it takes work and it takes patience. And then also kind of, I do want to shout out, my wife, who has always been very supportive of me. She kind of trusted me to manage, a huge portion of my net worth, and then from drawing down to coming back and making even more money. She's been my biggest supporter, and I'm always, forever grateful for that. And then the other people that I wanted to shout out, Christian, he was a turning point last year for me. A lot of my friends, Anthony Shee, who has been on the podcast as well, Paul, all of them Martin as well, J Law, they've all had a huge influence in making me feel that trading is not that lonely of a journey anymore. And of course, you guys, Richard, the TraderLion team, all the stuff that you put out, it's been fantastic. I've learned a lot, and it's been a very instrumental part of my journey. And of course, all the, the FinTwit people that I follow, Ariel, Nick, I'm very grateful that, I managed to connect with them last year, Shake. They're all great people, man. So yeah, that's all I have.
Cool.
Full circle moment.
Yeah, well, Clement, thank you so much for taking the time. I really enjoyed this, and to everybody watching here, I hope you really had a fun time too. This will be one to watch back multiple times and get new nuggets, I think. So, Clement, again, thank you so much for your time, for being a part of it. Any last words that you want to leave everybody with, or you've already shared so much, but any last bits of advice, or you all good?
I'm all good. I think I've left it all on
Cool.
the table.
Awesome. Well, Clement, thanks again. To everyone watching, again, I hope you enjoyed. Leave a like down below if you did. Subscribe if you're new to the channel, and we'll see you guys in the next one. Cheers.